that it is 9:30 and we do have a quorum. We will call this meeting to order. I think everyone before you might have an agenda. Is there a motion? Oh, no. Somebody just call in?
Yes. Reynolds,
is that?
Did you just join us?
Hi, Reynolds.
Good morning.
So if you take a look at the agenda on the board or in front of you, is there a motion to adopt the proposed agenda? We have a motion. A second?
Second.
All in favor?
Aye.
Aye. The ayes have it. I think also you should have seen on Watchdocs a copy of the December minutes. Would there be a motion to approve the minutes as posted on Watchdocs and as you see in front of us?
I move.
There's a motion. Second. Any discussion?
Yes. In the third paragraph, I think they appointed Mr. Hancock and I. The governor
Yes, indeed.
appointed me, and the treasurer appointed Mr. Hancock.
We'll fix that.
That is correct.
Apologies.
Oh, no problem.
I apparently did too. So, would there be a motion to adopt the minutes with those corrections? Do we need a new motion for that, or can we just, yeah, so if somebody would move that we adopt the minutes with those corrections.
I so move.
A second?
Second.
Okay. All in favor?
Aye.
Aye. The ayes have it there. I think the next order of business is our CEO report. So, Mr. Hitchcock.
Thank you, Madam Chair. And just for one housekeeping item, because we have Commissioner Williams on the phone, we've moved the conference equipment over, kind of shifted it over towards so that there's a microphone for the presenter to be able to reach. So if you're on this side, if you could just speak up just a little bit louder than you might usually, so that Reynolds, who's on the phone, can pick you up. First of all, just would like to remind everyone, all the commissioners and of course the appropriate staff, about the filing their statements of economic interest. Those are due, I believe, March 30th by noon, which is a very interesting time. So they're just remind everyone that they're due and that those are online on the Ethics Commission website. We can send you I think we have sent you a link, and we'll be monitoring those just to make sure that everybody files theirs and meets the deadline. We do, I think you've also been distributed your Code of Ethics forms. If you haven't had an opportunity to sign those and get those back to us, please do so. We'd greatly appreciate that. By statute, we have to, at our first meeting of the calendar year, we have to indicate that we do have a meeting schedule for the year, and the meeting schedule is posted. The meeting schedule for the year is posted on our website. So, also wanted to give everyone an update. I think many of you are aware that we are required to undergo a fiduciary audit once every 4 years. And our audit has to be performed, RSIC's audit has to be performed this year, 2018. The results have to be to the various members of the General Assembly and other stakeholder officials that it is presented to by January of 2019. The state auditor actually runs or is in charge of that engagement, and they ran a process to select the vendor for the fiduciary audit, and Funston was the firm that was selected. Many of us are very well acquainted with Funston. They're the ones who conducted the initial fiduciary audit for us as well as for PIBA. So they will be, I believe, beginning their work at the beginning of May. So at some point they may be looking to reach out and speak with all of you. But just wanted to make sure that everyone was aware that Funston was selected to perform the fiduciary audit this year. So, and we're pleased with that, because I think what we're looking for is, certainly an idea of how well we progressed in that regard. I believe there was 126 recommendations that they made in their initial fiduciary audit. So I'm very much looking forward to see how they think we've progressed in meeting those recommendations and the other, having them opine on some of the other changes and enhancements that we made along the way. So just wanted to announce that. The last item is that I have to report is we would like to formally endorse the CFA Asset Manager Code of Professional Conduct. And we would like to, unless there's, someone would have some reticence for us endorsing that. And basically what that is the CFA Institute has come up with a code of professional conduct for asset management firms. And asset management firms can choose to adopt that standard of conduct. It's not, we have right now about 32% of our managers, so about 19 of our managers currently claim compliance with the code. It doesn't necessarily mean that if they haven't claimed compliance with the code that they're in some way deficient. We are statutorily required to, we have a statutory code of conduct that managers have to meet. And if they have a code of conduct that is as strict or stricter, we can allow them to follow that code. But really the purpose of the code of conduct is to make sure that the asset managers understand that they're acting as fiduciaries, that they're acting in our best interest, set standards for things such as conflicts of interest and those types of things. And it's a push really towards a much more of a best practices kind of model. So we would like to, unless there's any objection, we would like to be one of the pension funds that have signed on as they in essence, they send out a letter every once in a while to asset managers, and they indicate the pension funds that are endorsing that, and we would like to be one of the firms that endorse that, or one of the pension funds that endorse that. We'll be working that into our ODD process, and one of the questions that we ask in our ODD, or operational due diligence process. So this is a proactive step on the part of us and on the part of the CFA. But I just wanted to let the commission know that we would want to be one of the pension funds that have endorsed that. So unless there's any major objection, I would like to move forward with that. So.
Another question.
Yes, sir.
Since that affects
what our, internal investment personnel do, should that be part of our COP?
It's not a code of conduct for us. It's a code of conduct for the managers that we select. So it's really the purpose is to create, I guess, a code of best practices to make sure that they are acting, that they understand the role of a fiduciary, and that their policies and procedures are in alignment with that role as a fiduciary for us, for the trust. So it's something that we're really asking them to do, and to acknowledge that they're in compliance with that versus us.
Okay.
Yeah. Okay. And that's all I have.
Okay, well, thank you. Next, the CIO's report. So, Mr. Berg.
Madam Chair. First of all, I want to take a few moments just to address the market volatility that had been quite absent from the markets for about a year and a half, but unfortunately came at us very swiftly this week. It's obviously not good to see a stock market down 10% in about a week, but I wanted to just use this as an opportunity to make a couple of comments. It's important to remember this is why we have a diversified portfolio, so that we're not taking a single form of risk. I also want to point out that even after the decline on Monday, which was the low point for this particular downturn thus far, I want to point out that after that decline, the stock market is still up over 20% from the beginning of calendar year 2016, and it's still up more than 35% from the point in time at the end of 2015 that the Commission voted to increase our exposure to equities. So I point this out because it obviously can be quite tempting to see only the short-term volatility and lose sight of the big picture, and I just want to reinforce that as a pension fund, our focus has been and will remain on the long term. We're going to talk some risk tools in a few moments that I referenced in the December meeting, but before we go there, I wanted to invite David King to give us a performance update. I believe we got our December performance 2 days ago, David, 3 days ago. So this is going to be an abbreviated discussion of performance, but of course, we're always happy to take any questions that any commissioners have.
Morning. So, as Jeff said, this is a shortened presentation, but as always, we send out a more in-depth report to commissioners on a quarterly basis, so that will come to you. But fiscal year to date through December, the plan was up 7.51% versus a policy benchmark of 6.69. You can also see our 3 and 5 year performance eking up over that 7%. For the fiscal year, we paid out $554 million in benefit payments. So looking at our performance in dollar terms, you can see we started the beginning of the fiscal year at $30 billion. We paid out $554 million in benefit payments, and then the investment performance added an additional $2.2 billion to the trust, leaving us at $31.8 billion. And this last slide here just shows our rolling universe peer rankings. So you can see the black line being our rolling 12-month, so our rolling 1-year percentile ranking. And then this gold line is our fiscal year-to-date line. So you can see we're just slightly under that median peer ranking for the fiscal year.
Can you go back to the earlier slide?
Sure.
Just as a new commissioner, I just want to make sure I'm reading it right. Net benefit payments, is that net of contributions?
That is.
Okay, thank you.
No problem.
Contributions, the full amount that the General Assembly funded for the 1% last year, roughly $118 million, all came into the plan at the beginning of the year as opposed to being spread throughout the year. So that may look different throughout the course of the year than it does on the front end.
I guess also to add. So that is creating actually the opposite. It's creating a greater cash outflow that we'll see, when the last payment will be made out of the corpus of the trust, as far as we see. That's July, right?
July.
Okay, so all of the Terry money by statute needs to be paid out between now and July, so.
Jeff,
so-
what was the total amount of the Terry?
I'm going to have to ask Peggy to help me with this.
And we had a big payout, I think, that was done in December, because a lot of people go into Terry, January 1st or June 30th. And I think that we may have about $450 million left to pay out between now and July 1st. I can get an update on those numbers and get them out to the rest of the commission so that you're aware of it. But I want to say that we have about $450 million left to be paid out.
So after that $450 million, what will be the end total amount to terminate the Terry program?
Well, people have been able to go into Terry since, 2001. So people would go into Terry, take their money out. So there is no point in time that we can say, here's all the money that was in Terry and we're pulling it out. It would go in and out of Terry throughout the last, 20 years almost.
And Ed, this, if you recall, we did something a bit unorthodox with the asset allocation because of the anticipation of these cash flows. We raised our target for cash to make sure we had ample liquidity from where it had been at 2% to 3% during this period where I think we changed it effective November through the end of the Terry program. So just to make it easier for us to make sure we had the ample liquidity so that we weren't taking any market timing risk to dispose of those.
Do I understand you correctly then that the end of the Terry program will be after this last payment of $450 million?
Well, don't think of it as a single payment. It's going to be a
Well,
little bit, but then it will increase at the end of the fiscal year again.
Okay.
And that's really what we wanted, was not to have to take a lot of risk as to where the markets were at the moment when we were making the larger distributions, so that.
And while Terry ends June 30th of this year, people can still go into Terry today and carry for a few months until June 30th. So the program itself is still open until June 30th, but everybody has to exit Terry as of June 30th. So those dollar amounts, if someone went into Terry today, they would have, 5 months of benefit payments that would accrue in Terry and then be paid out. So it's more of those benefit payments accrue and then are paid out when that person terminates.
And that was all I had for my very short and sweet presentation. But, if any of you have any specific questions, please feel free to follow up.
Do you have a kind of a flash? Through, I guess, through a couple of days this week?
So through Tuesday, and this is a very estimated return, but
Right.
we're the February to date return, so just this month to date, was about 3% impact to the plan. Fiscal year to date, that leaves us at about 6.61%.
Okay.
So,
So down, so basically the down 3.
Yep.
And what's the S&P down for the month to date? Okay.
It depends minute to minute, but yeah.
Through yesterday.
Yeah, through yesterday, month to date, down 5%.
Okay, all right. So
thank you.
espousing the benefits of diversification.
Yes. And indeed.
Right, yeah. That's why we diversify assets.
Let's see here. Okay. I wanted to outline, or Mike, do you want to discuss the AIP?
Yes.
Briefly?
Yeah. Madam Chair, and I think that we've kind of spoken with everyone about this at one over the past couple of weeks, but I think what given that we're kind of where we are with even though the development of the AIP and asset allocation are not necessarily synonymous, I think we've sort of, in our history, have made them somewhat synonymous. We are going through, obviously, a major kind of more bottom-up approach to our asset allocation this year. So what we would like to do today is highlight a few proposed initiatives that we may have in regards to the AIP. But I think that maybe when we're thinking about how we're going to develop this next year, how we would develop the AIP next year, I think maybe the course of action would be, and this is kind of sort of how the statute tracks it, is somewhere towards the fall, whether it's at the September meeting or the November, December meeting, whichever one that is. I think maybe we have a discussion with the commission, because the way that I understand how the statute works is the commission is supposed to provide Jeff and I with a statement of its investment objectives, in essence, for the next year, which helps guide Jeff in his development of the AIP. And it doesn't necessarily, need to be a bottom-up asset allocation review every year. I think asset allocation obviously needs to constantly be a focus, but when we're thinking about the strategic asset allocation, that's something that I think should be a little bit more permanent as we move forward. And the AIP should be more of what are we going to kind of within those bounds, what are we going to focus on for and other investment-related initiatives during the course of the next fiscal year. Obviously, if there's any significant changes, in the markets or things like that we need to address by way of a strategic asset allocation, we can. So, we will, once we get to the point where we, I think after today's meeting, we'll have a little bit more guidance as to where the commission may be going in regards to the overall asset allocation. So we'll be providing you with a draft of, the statute says Jeff's supposed to provide you with a draft AIP before April the 1st, and it's supposed to be adopted before May the 1st. But Mr. Feinstein's going to go through a couple of initiatives that we will be putting into the AIP But I think maybe if we start thinking about how do we make this a little bit more of a iterative process that is kind of focused more on what we should be focused on annually versus what we should be focused on kind of strategic long-term. I think that kind of bifurcation is, we can work into the process by which we look at the AIP, so. Like I said, Mr. Berg is going to, right, is going to do that. Right.
So 3 things that I would like for the staff to focus our time and energy on for the next fiscal year, and frankly, not waiting until the next fiscal year. These are things we're working to build out the investment risk function, and as to lay out in just a couple moments, we're working hard to develop new tools that give us different perspectives on the plan risks. And we think this is important to helping foster the right conversation with the commission. But also, we want tools that help us manage the plan. So this is not just simply creating tools just so that we can talk about them. We want to develop things that really can present actionable information to me and others on the investment team. The second point here is to continuing to evaluate the way that we structure the costs of the plan. One thing that I've been very focused on is improving our understanding of both. If we think of the total cost of the plan, I like to think of costs in sort of a corporate framework. You have fixed costs and you have variable costs. So I think of the fixed costs as being somewhat structural, but I'd like to go ahead and start attacking those structural costs and thinking about ways that we might be comfortable shifting and taking more variable cost and removing fixed cost. So that at the end of the year, when we see the cost of the plan, I'd like that to improve the alignment with our overall outcome. I think that makes sense. Third is currency hedging. It's a topic that frankly I would like to engage Makita's expertise on and invite them to lead us in this discussion. We've discussed this. I think that we've at times, and we being the staff, have struggled to come up with a strong recommendation regarding what we should do with respect to our currency risk. I think it would be most useful and beneficial for us to have that conversation with our consultant so that they can guide us through how are other plans thinking about this and how are they structuring their thoughts on this topic. So, those are 3 kind of bigger strategic things that I think we need to be focusing on. And if I certainly want to be open to other ideas that the commission may have. These are things that are important to me that we focus on, but I'd rather see this list grow rather than shrink. But I'm also absolutely enthusiastic to consider other potential goals. So,
Jeff, can you give an example of how you view the difference between structural and variable? When you say structural, I mean, that could be the budget of the agency.
So, what I'm thinking about is the structure of how our managers are compensated. So what I would, if there's think of it as you can have an amount that you're going to pay regardless of performance, and you can have an amount that you would pay that is conditional upon performance. I would like to explore ways that we could shift from the compensation that does not depend upon performance to compensation that would depend on performance. So I think that improves alignment, but the conditions have to be right. And I think is that a
Yes,
clear,
that was
responsive?
kind of distinction I needed.
Okay, good.
Thank you.
Thank you.
Kind of the difference between so that's the more, contingency fee more based on performance rather than just in the investment managers in essence get both a lot of times, the fee and the carry. So the more we can push to their the more that we can push to, they get paid for their performance rather than just get paid to hold our money. I think that's better.
All right. So, and I don't want to put everyone on the spot, but if there are ideas, please speak with, I mean, certainly we can talk about anything here, but I'm very interested in hearing if there are other strategic ideas that you would all like us to explore. So if there are no questions, I will be happy to keep us moving. So what I want to do now, Madam Chair, is to share with you all what we've been working on with respect to our risk management function. Before Jonathan Grob comes up to discuss it, I want to share with you the ways that I've laid out the goals for James Wingo and Jonathan, the two people that are our risk team today. First of all, I've asked them to shift their focus or shift their perspective when they think about risk management from being a top-down or from a bottom-up approach to being a more top-down strategic approach to risk. So I've asked them to think of what we're doing over the next couple of years as creating a mosaic. In this analogy, each tile would represent a different facet of the plan's risk profile. So my thinking here is that when we develop a number of these different tiles, each one offering a look at a different facet of the plan's risk, we wind up with a more comprehensive overall picture of the risk of our plan. So the first tile, to continue the analogy, the first tile that I've asked them to work on is what we're going to see today. And what I asked for was two things. One, I wanted to create a simple risk benchmark. And I wanted to be able to, the second thing, I wanted to be able to see how our portfolio risk is reacting in real time. And this is not something that we have been equipped to do, but I'm really proud of the work that Jonathan and James have I'm proud of what they've achieved. I want to pay tribute. This is a concept that I've had conversation with you all. I am always happy to benefit from the work of others. And this borrows heavily from a concept from one of the Canadian pension funds, which compares portfolio risk not simply to a static volatility level, but to a reference portfolio. And that's the kernel of what this tile represents. So before Jonathan takes the podium, we don't believe this is the finish line. I want to make that clear. We're going to continue to push to improve and evolve this concept, even as we move on, and we're thinking about other tiles as well. But I'm proud of the start that these guys have given us in this regard. So I would like to have Jonathan walk us through this. And as with any risk conversation, well, you can go. Oh, I'm sorry? Oh, sorry. As with any risk conversation, we run the risk of it being a very technical conversation. So hopefully we've kept that to a minimum, but by all means, if you have questions, let's have that discussion. So, Jonathan.
Do you want to brief this, Jeff?
Well, this is really what I just hit on. So let's move through this to the night. We'll get into the meat of your.
Good morning.
Stuff.
Thank you for having me. I'm excited to present some of the work we've been doing with the strategic risk framework for the plan. I'll try to keep the technicalities to a minimum here, but a little bit of history. As Jeff said, he tasked James and I to look at the plan risk in a simpler approach that would be more easy to translate to broader audiences. And as a result, we settled on the idea of transitioning from the current bottom-up approach, where we aggregate every security level position we have into some composite risk view. And instead of that, we're going to shift to a top-down approach, where we look at allocation-based. And this actually aligns more closely with how we can impact the portfolio as managers. We're not trying to influence a manager's active bets. We're trying to model our risk to our strategic allocation, right? That's the decision we make, is how do we allocate between asset classes. And as a result, we're going to weight each asset class with a representative index, right? And at the bottom, you can see the weights of these various indices. And we break it out into a little bit more detail than just global equity and core fixed income, et cetera. We actually drill down quite a bit. But we've discovered that comparing ourselves to a 70-30 stock bond portfolio actually works rather well. When we regress the current allocations returns through time against that 70-30, we can actually explain more than 90% of the variance in returns. So we feel like that's a pretty good match. And that's not really surprising. That's because the risks to our current allocation as well as the 70-30 are largely the same. That's market risk and interest rate risk. Admittedly, there's others, but they're small in comparison. And finally, instead of thinking of risk in terms of an absolute number, we're trying to transition to that of a relative number. So compared to that risk benchmark, the 70-30, how risky are we compared to it, right? Relatively, where do we stand? That should enable asking and answering a pretty simple questions. How is our risk changing relative to the benchmark? Which asset classes and sub-asset classes are driving those changes? And what, if any, are acting as effective diversifiers? So the major pro of this approach is that it captures more than 90% of the portfolio volatility. And it can operate in real time because we're not relying on managers to submit their individual positions to us, 200 plus managers with tens of thousands of positions. This is not something that's easily gatherable in real time or even possible necessarily. But in this approach, we can act in real time as quick as index data is published, which means daily. So now we can transition to actionable risk management rather than just reporting 2 or 3 months in arrears risk management. Furthermore, the approach we're developing does not rely on the assumption of normality of return distributions. This is important, and we'll go into why later. But when we start calculating tail risk, this is where this is really crucial. And furthermore, this is a fully flexible framework that we've developed internally, which means we control it. We control every choice of view, of option, whatever window we want to look at, methodologies. It's all very transparent. But some of the considerations, to the extent that our managers are generators of excess returns, we're not attempting to model that. This doesn't model alpha with beta. But that's okay, and that's actually the strength of this system, that we feel at least.
Can I pause you there for
Sure.
just a second? You just made what I think is a very important point, because when we hire an active manager, we count on them not looking like the index. That's what we're paying for. And if when we roll up across our plan, we're going to roll up a lot of these tilts that they make. And what we don't want is when we roll it up in aggregate, we don't then want to undo the very tilts that we're paying them to make on our behalf. So this is a concept that I think is important but subtle. So apologies. I'll get out of your way now.
But this is also one of the system's greatest strengths. Is because of that, we have real-time data, right? We're no longer waiting on the managers to submit their data at whatever lag. I will try to keep this to a minimum. I apologize for the statistics graphs. The general methodology here is we're going to extend the current allocation back through time, as far back as we can get good data for, which right now is pretty good, and we're making it better every day. Again, we're attempting to capture non-normality of asset returns. Whenever you're talking about tail risk, there's almost always this assumption of normal returns, but that's rarely, if ever, the case. Most asset classes show some degree of skewness or kurtosis, which are pictured at the bottom. And we'll go into some examples in a little bit. But then we're going to calculate all of these risk metrics, whatever we decide internally. Again, this is a flexible framework. We can change these or add to them on the fly at staff or the commission's direction. And we calculate them at every day, going back through history for the current allocation. This allows us to implement stress tests. We can see how the current allocation would have performed at any point in history. And furthermore, now that we have a risk benchmark, we can see how that 70-30 would have performed. So are we doing better during stressful scenarios? Are we doing worse? This gives us actionable intelligence. If we decide that one scenario is not not acceptable to us compared to the risk benchmark, we can take action. Some of the examples, for instance, of a negatively skewed asset class, that might be like credit, where you have these small, regular gains the overwhelming majority of the time, but sometimes there are large losses. That's that long left tail you would see on the negative skew. As you can imagine, if you're attempting to model tail probabilities, changing that left tail can mean a lot, right? Whereas on the positively skewed, for example, that would be like being long a call option, where the amount you can lose is fixed, but the amount you can gain is unlimited. Obviously, that has a much different loss profile than that of credit. And then most asset classes fall somewhere in the middle. So here's a sample output of our system. This is a moving average that depicts volatility of the plan versus the risk benchmark. And the blue line is the current allocation, the orange is the risk benchmark. As you can see, we hug it very closely. This is another reason we feel this is a acceptable risk benchmark and even possibly a very good one. We're not above it all the time. We're not below it all the time. We feel like this represents a reasonable choice. This weighting methodology, it can also pick up on short-term moves very well, but it comes at the expense of potential whipsawing. So we've developed some other views, but this is the one we feel the most comfortable with. As you can see, following the sell-off on Monday, we are slightly more risky than the risk benchmark, but that is a very modest difference. And indeed, we're still in a period of low volatility despite that. Although that may be changing, you can see that prior to Monday's spike, the realized volatility has been very low for both us and the risk benchmark here. This is the exact same graph I just showed. But this illustrates the capabilities of the framework we've developed. We can actually break out the risk in terms of contribution from asset classes. And we can go even further. I won't show those because they get very messy, but we can look into sub-asset classes. We can look into large caps, small caps, option strategies, you name it. We can break this out into pretty much any breakdown that's desired. As you can see, equity, the light blue at the top, represents the overwhelming majority of plan risk. But that's not surprising, right? If I were to show the 70-30s breakdown here, it would be all blue. They're 99.5% equity risk at some points. So in that regard, we're actually substantially more diversified than our risk benchmark. And that's important, and I'll get into why later. This is just the snapshot of Monday, and this shows what changed. Before the sell-off, equity represented about 69% of our risk, whereas during it, it's 78%. That just shows how fickle equity can be, right? We all know that. The stock market can go up and go down. But what changed on Monday? We saw very limited diversification, actually. The traditionally diversifying assets didn't offer much shelter during the sell-off. And how do we determine the contribution to volatility from various asset classes? It's not simply the weight to that asset class and its volatility. It's also determined by correlation, and this is where diversification comes from. When correlations increase, diversification decreases, and that's exactly what we saw on Monday. But volatility is just one measure of portfolio risk. It's the most obvious, but it's not necessarily the one that has the most meaning to us. An asset can be volatile because it experiences a large increase in price. This usually isn't a bad thing, right? I would argue that we probably care more about the extent and odds of large losses than we do necessarily volatility. And that's where these other metrics come in, value at risk and conditional value at risk. Value at risk is, what's the most I can expect to lose over a given time frame given some level of confidence? Whereas conditional value at risk is, given some large loss exceeding value at risk, what's the average I expect to lose? And we've chosen to focus on conditional value at risk. We feel it's a better metric. Again here, the current allocation is represented by the blue line, and the risk benchmark is the orange. And this shows it going back through time to the beginning of 2015. As you can see, following Brexit, we actually exhibit substantially less tail risk than our risk benchmark. A little bit of that got eroded on Monday's sell-off, but it's still lower. And this is likely because of the lower equity risk in the portfolio that I spoke about earlier compared to the risk benchmark. The risk benchmark's overwhelmingly equity risk, whereas we're a lot more diversified than that. And here we're reaping the rewards of that.
y-axis. Remind me of what that is measuring.
That is giving a loss at the 95% confidence level. If we have some large loss that exceeds that, that's the average of that loss over a 1-year horizon.
Bad outcomes, what's the average of those?
The average of the
Really
worst
bad
outcomes
outcomes.
we could reasonably have. And where I was harping on non-normality of asset returns earlier, this is where it's crucial. If we were in a positively skewed portfolio, our tail risk would be much different. And under traditional CVAR, conditional value at risk metrics, they assume normality. But we've taken a different approach and employed something called Cornish-Fisher methodology, which penalizes negative skewness and kurtosis. That allows us to actually adjust these metrics for when our assets exhibit non-normal return distributions. And so what are our next steps? How do we want to continue to develop this? We'd like to develop ways of monitoring systemic market risk so that we can attribute market risk rather than just equity risk in the portfolio, because certainly other assets can have market risk, not just equities, right? Also, we'd like to create measures of asset class drawdowns that can help inform liquidity analysis. That's what we view as the next tile in our risk framework. Drawdown analysis is crucial to liquidity. Also, we want to test for evidence of mean reversion among asset classes, managers. Pretty much any of the sub asset classes we spoke about can be tested in this framework. And that has important implications for rebalancing. We also want to quantify changing correlations between asset classes and estimate tail correlations so that we're not assuming a correlation remains constant during a crisis. We want to have some estimate of what it can actually go to. As we saw during Monday's sell-off, it changed drastically. We didn't get the diversification benefit we would have hoped for. And finally, we want to estimate plan and asset class level factor betas. What that means is we want to find our sensitivities to external factors. As Jeff previously mentioned, we're looking at currency hedging. It would be useful to see what kind of currency risk our current allocation has and what kind of currency risk the risk benchmark has. Are we more, are we less? This is something we'd like to develop, and this can inform those hedging mechanisms. Sure.
Rather than just equities, earlier you had a graph up there that showed the blue was equities, high volatility. It looked like we were measuring risk at all the different classes.
Right.
But that bullet said just equities. I was
Right.
wondering.
The purpose of that is to estimate how much, when we think of market risk, we typically think of equity risk. However, there's really market risk in every asset. For instance, we know real estate, right? If equities suffer some significant drawdown, oftentimes real estate will as well, right? Think of the global financial crisis. So it would be useful to know how much of our risk in other asset classes is coming from market risk that we typically associate with equities.
Okay, so market risk is talking about the stock market overall.
Generally, yes,
Yeah.
but that's a simplification, but yes.
Yeah, okay. I'm a simple person.
That's all right. And with that, I'd be happy to take any questions, but this is where we're at with developing it and where we're hoping to go.
This is remarkable. Very, very impressive. As I always am with all the work that your group does. Can I ask a question like how would can you give me an example of how we would use something coming out of this as sort of actionable intelligence to make some sort of change or accommodate?
Sure,
what you see?
absolutely. So let's pretend for a minute that I have this graph broken out, the light blue of equities. Let's say I've broken it out into large cap, small cap, equity options, emerging markets, EFA, et cetera. I don't show that because it's a very messy graph. But if we see one of those sub-asset classes have a wild spike in risk, we may decide that's okay. We may decide that we like the risk. But this informs us where that risk is coming from. Are we comfortable with that much risk coming from one asset class? Well, this framework allows us to decide, or at least make the decision, whether or not we are. We can identify it in real time.
One other way is hedging concept. I think what we would want to see is to see the contribution to risk because most of our currency risk is attached to equities right now. So frankly, it would be to create a new asset class that would be equities without the currency risk, load that into this, and see if that is a more attractive risk profile, not only across the distribution, but look only at the tails, look at the CVAR, and see how does this change our really bad outcomes. And then how does it, so we're trying to understand what is the give and the take if we make a decision like that. So thinking prospectively about action and its impact on risk, I think is we don't have a rich tradition of having risk tools to consult with these decisions. So it's basically adding another instrument in the cockpit so we can consider prior to making those types of decisions. We have instincts, and I think our instincts are pretty good. Frankly, we thought that our portfolio risk was going to be really close to 70-30, and it wound up being basically right on. So instincts are good, but that's taking a point in time, and we need to think about not just today, but if we push what we're looking at today back through some historical episodes also, how does that inform our decision-making? So.
Do we track the 70-30 pretty well over all portions of time, or are there periods where we get off of that, and if we start to get off of it going forward, would we?
Well, I think that creates a discussion.
Yeah.
What is it that's causing it to? Is it something in the 70-30 that's happening? Is it something in our portfolio that's happening? Which is starting to change its behavior, and how do we diagnose it?
Right.
Other than simply waiting for returns? How do we see it happening? So Jonathan has been building this and kind of pushing our window back. How far back are you now?
With daily
this?
data, we're limited to going back to about 2011, if I recall. I'm working off memory here. We can switch to monthly data in the framework and extend back before GFC, I think to about 2003. Our goal presently is to extend daily data through the GFC, just because there's much better fidelity. We can estimate tail risk better. Monthly can understate, right? If there's a big event during the month, but it mostly resolves by month end, we would lose sight of that. And we don't want to lose sight of that. That's the whole beauty of the system, is to have that daily fidelity, to know every little piece and be able to drill down into any detail.
Yeah. Go ahead. Sorry. Go ahead.
Can you talk a little bit about the construction of the risk benchmark? And it just seems that, obviously, if you look at this graph, current allocation is almost exactly the same as the risk benchmark. And I guess, at the risk of being simple about it, a loss is a loss. Whether, if the benchmark, if you're down 30% and we're only down 28%, you still lost a lot of money.
Absolutely, but the goal of this is not to think in terms of returns, but to think in terms of risk. So are we taking more risk than a 70-30, which is actually kind of a representative choice of kind of broader investment communities, many other pensions.
What our statute is.
Well, and that's equity allocation, not equity risk, which is, you get how those are very different concepts.
An actual 70% equity allocation would mean about 99% equity risk. And that's what I was speaking to earlier on this chart. We're substantially more diversified than that 70-30 is, despite their higher allocation to fixed income, which certainly has its own benefits. At least by assets, we're more diversified, and that's actually why our tail risk exhibits better properties. We don't have that same equity risk that a 70-30 does.
Is that helpful, Ed? Yeah. So what I found really interesting about the concept was you really just don't allow yourself to create a granular risk benchmark. You're really forcing it to be something that's simple and intuitive. I think everyone understands 70-30. you just understand what's happening. Now, what I think is particularly powerful for us and how we think of risk, you know, and not to beat up on poor Frank here, but what we're doing with asset allocations is we're estimating an average level of risk over 20 years, right? And I don't recall exactly what the level is, but let's just say 13%. We've been running at slightly more than half of that risk for the better part of a year now. What is the utility of thinking about 13% risk when in reality it's closer to 7%? So what we think is more helpful is watching the absolute level of risk evolve against something that is not static, but it will also be evolving. So we're able to not simply judge risk and say, well, we're doing great from a risk perspective because our portfolio is running 7% where we assume it's 13, because the other environment will arrive at some point and we will run 18% vol for a period of time. That should not suggest to us that the right thing to do is to move half the portfolio into cash to avoid risk. You know, but what we need to be doing is understanding the risk levels and what are the potential implications for our portfolio.
Tracking, comparing the risk benchmark to our allocation, current benchmark, or our current allocation, were we talking, was the risk benchmark a 70-30 equity to fixed income allocation?
Global, yes, exactly. Okay. That's exactly what it is. Okay. 70% global equities, 30% the old, what used to be called the Lehman Ag, the Barcap Ag, right, core bonds.
Okay, so if our risk is the same, essentially the same between a kind of simple 70-30 allocation compared to our more diversified, maybe more complex, maybe more costly allocation, why would we choose the more complex, more costly allocation?
That's a fantastic question. Well, what we're talking about here is simply two forms of risk, right? So there are two axes of risk. And 70%, well, I think Jonathan pointed out one of the reasons. So your contribution to risk is going to be 99% driven by one asset class. And if that is something that's not something I take comfort in. Right. But you also, frankly, what we're not showing is what is the return profile. I mean, if you take one path versus another, we're not just looking to judge it in the form of risk. We also need to contemplate whether it is also attractive from a return perspective. Absolutely. So, you know, this is what we're doing today is just simply focusing on risk and picking a level of, you know, this we're drawing the line somewhere between 0 and 100 for stocks and bonds to create a very naive portfolio. So, and I certainly want to hear
I was going to say,
Nikita's perspective as well.
One of the things that's important to think about from these exercises, not just the risks that you're taking, but really how's it going to recover and when's it going to recover, right? I mean, like you can have two stocks. I mean, if you imagine one that pays a dividend, one that doesn't. In a crash, they're going down the same amount, right? But the way they recover is going to be different because say they just sit there for a year, right? So in the one, you're going to sit there and print dividends, you know, for quarter after quarter after quarter, right? And let's say that's a 2-year period. And then let's say, you know, the economy recovers and the other one kind of catches up, right? So the recovery might ultimately look the same, but the price path is going to look materially different in the recovery, even with two assets that over a long period of time have the exact same return, right? When they earn the return and how they earn the return are materially different, right? And I think that gets lost. And that's the thing I'd say about correlations. I mean, the reason correlations spike is because it's the same trading desk, right? It's not because the assets suddenly are correlated, but it's because some damn bank owned them both, right? And once you realize that's the mechanism, right, versus do you understand the economics or do you understand the players, right? It changes. So it helps you inform to know, all right, how big is the drawdown? But I think the more important thing is how quick can I recover and how do I recover and what's the mechanism by which I recover,
right? And the more confidence I can have in that recovery, the better portfolio I think you have, right? But because the risk isn't constant, to Jeff's point, right? You know, because every asset has two components, an income component and a capital gains component, and one's a little more predictable than the other, last time I looked.
And to kind of build off of that, what we're not showing you here are drawdowns. You know, we're just showing you a simple expression of volatility. So this is a facet of the picture, you know, and over time, we hope to be able to present a much more comprehensive picture, you know, drawing on multiple analyses, you know, looking at drawdowns through, you know, scenarios, taper tantrum, financial crisis, dot-com bubble, 1987, you know, the high inflation, you know, in the early 80s. We need to look at how we think our portfolio would react during various scenarios as well, which is, you know, a part of what we do, you know, as we build this out. So, you know, this is what I don't want to jump to powerful conclusions right now, because we're showing you, you know, the very first, you know, naive kind of portfolio to compare against, and you know, this is the beginning of a new path for us, you know. So, but absolutely, the right question to ask.
Thank you.
Yeah, and that ties into to our beneficiaries and how volatility affects the long-term outcome for keeping the plan solvent and paying benefits. And so I'm hopeful that that'll be another tile as you build the risk framework.
I believe liquidity is the next piece on our calendar, actually.
Well, but I certainly agree, because we are here to service a long-term you know, benefit purpose. So, absolutely. So, are there further questions on this? Okay. Thank you, Jonathan. Good work. The next discussion is the continuation of our, well, sorry, I thought it was under my section, but I'm getting ahead of myself.
It's its own section. Ah.
So,
Well, to continue where Jeff left off, our next item is a continuation of our discussion on asset allocation, which we are delighted to have Makita continue to lead us in. And I will turn it over to you, Frank.
Thank you, Madam Chairman. Good morning, everyone. Thank you for having us again.
good morning.
So I really want to thank Jonathan for going through the primer on risk for me and saving a lot of the comments I was going to give and perhaps simplifying some of that. We obviously sat down in December and walked through a wide array of asset allocation options for you. And a lot of these were illustrative. We were saying, well, what happened if you just didn't have any private markets? Or what if you went to the extreme limit that you're allowed by law, 70% in equities? Or what if you didn't have anything in non-U.S. currency? That's not what we're doing today. Today we're really focused on what are portfolio options that we think would make sense for you. Now, since the December meeting, as some of you know, we had phone calls with a number of the commissioners. I think the majority of the commissioners gave you the opportunity to express your thoughts and opinions, and we really appreciate the time.
I just want to thank you for that, because it's the first time we've gotten that level of service from the consultant, so I applaud you on that, and thank you for that.
Thank you, and again, we want to thank you for taking the time to speak with us. So we were to take that in and where appropriate, address those specific thoughts throughout this document. You'll see some right in the body, some in the appendices of the documents. Obviously, we continue to work with staff to go back and forth on our collective thoughts. And the other thing that really changed in the meantime was essentially the calendar year rolled over. And what that means for us as a consultant, and really any consulting firm, is we update our capital markets expectations. That is, our expectations for what returns are going to do, for what volatility is going to be, and for what correlations are going to be. The correlations and volatilities tend not to change much from year to year. The expected returns will change. They don't tend to change a great deal because we're looking at 20-year horizons. So even after a year like 2017, where stock market's up 20-some%, when you roll that out over a 20-year horizon, yes, that's going to reduce our expected returns, but not by a very large amount. In our case, it reduced our expected returns for equities by about 20 basis points. And across the board, most of our expectations for returns came down by somewhere in that same ballpark, let's say 20 basis points for a total plan level. And that is mostly because it was a good year for most risky asset classes. Equity prices went up, and spreads, so for like credit, spreads came down, so yields are down. Pretty much the only asset class that looks better than it did a year ago is cash, because short-term rates are higher than they were a year ago. So that did change the output of our models. What we're going to show you on the following pages are 5 policies. One is your current policy. One, which really isn't a policy, is the peer average, so the average of other large public pension plans. And then 3 alternatives for you to consider today. And they represent various levels along the risk spectrum. Now, I want to point out that you're not going to see large differences between these 3 portfolios or between them and your current portfolio. And a big piece of that is because your portfolio is already very well diversified. It is a well-constructed portfolio. We think you can make some enhancements to it, but I do want to say it is a very good portfolio. And what we're talking about are improvements to it, not wholesale changes to it. The other thing, as we go through the risk metrics for each of the portfolio options, they represent a snapshot in time. So, Jonathan showed you that nice chart showing how volatility changed from, really on a daily basis. This is assumed to be an average over time, as Jeff said. It's that average. So, yes, for the last year and a half, you've been well below that average. For this week, you've probably been above that average. And we tend to be conservative in our assumptions. We assume that, correlations are, when we do our correlation expectations, for example, we assume you're going to have the correlations that you had during the bad periods of the market, not necessarily the good periods of the market, right? So we're worried about those correlations when we build those into our assumptions. We are comfortable with any of the 3 policies that we're putting forth today. And I'm just going to jump ahead a little bit here of myself. We don't have a pound-to-table recommendation saying to you, this one is definitely the one you want to go to. There is no one right portfolio, but these are all portfolios that we think highly of and options that we think you should consider. So page 10 here shows, as I said, your current policy, 3 policy alternatives. We labeled them X, Y, and Z. The peer average, and then to the far right, a range for each asset class. So a couple things to note. Number one, these are bucketed a little bit differently than what we showed you in December, mostly for simplicity. So, for example, if you look at equities, we're just listing 2 line items here, essentially public equities and private equities. Now on the next page, we break it out a bit more finely, a bit more detail, so we can say, okay, within public equities, this much in U.S., this much in developed, this much in emerging markets. But for simplicity, on this page, we want to keep it at a pretty high level for each of the asset categories. The 3 policy options, X, Y, and Z, essentially represent increasing amounts of risk and return. So policy X is similar return with slightly less risk than the current policy. Policy Y, slightly more return for similar level of risk. And policy Z, higher risk, higher return than where you are now. The target ranges are not necessarily symmetrical, and this is based partly on feedback we got from previous asset allocation discussions you've had. For example, wanting to keep a higher range for cash, so cash has an allowable range of up to 7% here, and up to as much as a 10% overweight in bonds. So in order to accommodate that, if you were to have a flight to quality, if you wanted to go into safe assets such as bonds and cash, you need to have the ability to go even lower within the equity allocation. At the bottom of the table, a couple of things to point out. One, the non-US dollar exposure. We tried to keep this fairly constant. As Jeff indicated, we anticipate a conversation later this year about currency hedging. But for now, we want to keep that currency exposure pretty constant, not to necessarily take on increased currency exposure. For example, on that next page where we were increasing emerging market equities, we would often decrease the developed market equity. So you would still take non-US currency risk, but in a different place. At the very bottom, as I noted, the expected return and standard deviation, a measure of risk, one of many that fits into, and again, using the same analogy Jeff does, that mosaic of your risk profile. Standard deviation is one of those tiles. And at the very bottom row, what are the odds of hitting your assumed rate of return? And we talked about this a bit at the last meeting. The odds are a little more than 50% for each of these policy portfolios, not much more. We're talking still less than 55%. They are higher than the peer average going forward. And for a number of reasons, not least of which heavy reliance upon fairly expensively priced asset classes for that peer average group.
To understand what those probability numbers are, because it's, I think it's important to know that it's not a 53% chance of getting 7.25 or nothing. There's a 53% chance that your outcome over time is going to be 7.25 or better.
Or much
right?
better.
Right, and then on the flip side, so I think it's a better, there's a better so it's not a barbell, it's a range of outcomes.
It is, and if you recall, there was a chart that Jonathan showed that had that bell-shaped distribution. So that's saying there's essentially, for policy Y, a 52% chance that the outcomes are going to be to the right of 7.25. Most of those are going to be not a lot more. They might be between 7.25 and say 8.5. But there are reasonable odds of it being significantly more than that. In any given year, it could be much more than that. The way if you do a shorthand for the standard deviation, plus or minus one standard deviation accounts for 2/3 of all outcomes. So in 2 out of every 3 years, you expect your return to be between 21% and about -8%. And in 19 out of 20 years, add more to that, another, say, 34% to -21%. But that's in a single year. That spread tightens considerably as time extends. You get out to 5 years, 10 years, 20 years. So some of the themes that are common among the portfolios. The first is a reduced target allocation to cash. Now, you heard Jeff say that for the short term, essentially the next 6 months as the Terry program is wound down, the actual cash allocation will be higher and certainly well within the allowable range. We have a range of up to 7%, but that longer term, the intention would be to reduce the cash target, and because cash ultimately, even with rates going up, is still the lowest expected return asset class you have. So a bit of a drag on total portfolio returns. Alternatively, you would be increasing your allocation to core bonds, and specifically within that, adding an allocation to TIPS, something you don't have. Recall we talked about TIPS, went through a presentation on that at the last meeting, and slightly increasing the allocation to treasuries. One thing of note on the treasuries, over the very long term, we'd like that to be more long duration bonds than intermediate duration bonds, but we want that discretion to fall to your staff, and we've modeled it to be the reverse, really 80% intermediate and 20% long duration, essentially because of the current shape of the yield curve. And right now, you're not getting paid a lot to take on additional rate risk. We have a fairly flat yield curve. And over time, hopefully as long rates go up relative to the rest of the curve, it would make sense to move more into long duration bonds. But we think it makes sense to give staff that discretion to do that.
Frank, can I jump in on one thing? Just for the purpose of clarification, in the current policy, you'll see, with respect to core bonds, you see 6% in nominal investment grade bonds, 4% treasuries. That's really it's an approximation of the breakdown for the index that we have, the bar cap aggregate index, which includes both pieces. So I think right now it's 37% treasury. So this is an approximation of what we have today. We don't have separate allocations. So this is just sort of building or breaking apart the index and reflecting it in this way. So.
But, and I'm probably jumping ahead, but with the current interest rate environment, thinking rates are going to go up. Because of the prior slide, I think it said we could go, was it up or down 7% or just down 7% if we decided we didn't want to invest, if we adopted something like this, any of those plans. We've still got the flexibility to decide at this point in time, we don't want to put 6% in long-term treasuries.
Correct.
Is that right?
Yes. Yeah, so you've given staff the ability, or flexibility, if you will, to allocate within that range. It's my understanding staff has not historically moved up to, say, the extremes of their target ranges. They haven't made use of that historically. But then you're giving them extra level flexibility of saying, even within that, how much they can change between, say, bonds that have less rate sensitivity and those that have more rate sensitivity. So it's essentially two levers they can pull. Next theme I would mention is a reduction in public credit. So that would be your high yield and your bank loans. Credit spreads have come down considerably. They're not that attractive on a forward-looking basis, especially relative to the risk inherent in them. Private credit still does seem to be more attractive. Rates have not come down, or I should say really coupon rates have not come down as much. So we're saying let's reduce the public credit piece and reallocate that elsewhere. So that might be reallocated to core bonds, or in some of these portfolios, reallocated to equities. Within equities, you can see the difference between the three portfolios, X, Y, and Z, is an increasing amount of equity risk, with policy Z most closely resembling the peer group. And then within that equity bucket, what we're talking about is increasing the exposure to emerging market equities. So current target and really of about 4%, and this really reflects more, again, the breakdown of how you're actually allocated than a specific target. But this would be saying, set a specific target of 6% for two of the portfolios, 7% for one of the portfolios to emerging market equities. And we talked about at the last meeting, the two asset classes where we have the highest return expectations are emerging market equities and private equities. And we're not alone in the industry in this thinking. Talked to the last meeting, there's a survey done by a third-party actuary of 36 different consulting firms. The two asset classes with the highest expected returns, private equity, emerging markets. So if we are crazy as a group of consultants in terms of our expectations. But that is the industry theme. Within real assets, potentially a modest increase, but not significantly, and this would be within real estate. So we're talking about increasing real estate from 8% to a 9% target. Perhaps the more important change there is a reallocation within the real estate bucket. So you're predominantly non-core real estate, so value add and opportunistic real estate right now. Ideally, we've talked about with Jeff, what he'd like to do is shift to a portfolio that is more core real estate than non-core real estate. and I'll talk about this later with implementation issues, that's going to take time. That can't be done overnight. The last category there is opportunistic. And for all three portfolios, we're recommending that you keep the Portable Alpha program. Slight reduction in the tactical asset allocation, essentially to move the assets into equities or rate sensitive. Then finally, that other opportunistic category. The idea here is that this would be truly opportunistic. You don't want to have a permanent allocation to something there, because if that's the case, it's not really opportunistic. The idea is if there is an asset class or a strategy that appears particularly attractive at a certain point in time, this would be the place that you could allocate to it. And you have a range of up to 3%. If it's something that staff determines is something they want to have a permanent allocation to, then we would probably find a permanent home for it somewhere else. In the meantime, we've moved the risk parity category, risk parity allocation into that bucket, and that can serve as a placeholder, if you will. So assets can sit there. They tend to resemble the rest of your portfolio. I mean, it's invested in public equities, public bonds, et cetera. Any questions on this page before I move on and start talking about the risk metrics that help compare each of these portfolios? Okay. All right. So first thing I'll mention are the implementation concerns, and I think Peggy, you'd asked about this at the last meeting. Number one, there are no significant liquidity concerns with the proposed policy portfolios. As I mentioned, the slowest transition is going to be within real estate. Most of that non-core real estate are in what are called closed-end funds. So these are funds that have usually a life of 10, 12, maybe even 15 years. Now, they may gradually return capital over, say, years 5 to 10 or 15. So you're not getting it all back at the very end, but it takes a long time to get your capital back. So it's hard to take the money out of these assets and move them into core real estate over a short-term time horizon. So that is going to take a number of years to execute upon that. There are ways to do that more quickly. And you can explore co-investments, and we're going to talk about this with private equity as well. You can also explore selling some of these assets in the secondary market. The downside to that is mostly pricing. Usually if you're trying to sell something and somebody knows you need to sell it or want to sell it, they're not going to give you the best price for it. So there are downsides, and you probably wouldn't get the return your staff would expect to get if they left the assets in those portfolios. The credit strategies, reducing that and shifting some assets in public equities would probably be the most seamless change. You probably would not need to hire or fire any managers necessarily to execute on that. Of course, if staff has certain opinions about what they want to do with their managers, they may make changes to them. Where you will need perhaps new dedicated strategies, or at least a change in the mandate, is with TIPS and a dedicated allocation to treasuries. The quickest and easiest way to do this is through index fund managers. But you can also explore active management there as well. But this can be, or you can even use the futures market to gain exposure here. So a number of different ways to execute upon that fairly quickly. Finally, as I mentioned, I don't think I mentioned, you're currently below your target for private equity. So we're only talking about increasing the private equity target in Policy Z. But as it is, it's going to take a couple of years to get you up to your target. One thing Jeff is talking about is exploring co-investments, as investing alongside other partners within individual deals in private equity. This is one way to increase your private equity allocation without necessarily allocating to more managers or more money to those managers. The idea is not to get there overnight. There's some risk to trying to put a lot of money into private markets, or really any market at any given point in time, given that might be the peak of the market. And that's why most investors tend to take sort of a dollar cost averaging approach to investing in private equity. So flipping ahead to the risk, and Jonathan gave a bit of a primer in a sense on tracking error, and Jeff did too. What you see in this table is an estimate of tracking error relative to that peer average portfolio that we put forth. So again, not tracking error relative to your policy benchmark, but relative to that peer group. Because now most public plans, including yours, are cognizant of your peer group and your performance relative to that peer group. So what this says is that with your current policy, in a given year, you could expect to be 1.5% more or lower than the peer group. And again, the one standard deviation, so that goes back to that math I was talking about 10 minutes ago. So in 2 out of every 3 years, you would expect to be within that range, plus 1.5% to minus 1.5% from that peer group. At the extreme, so 2 times that, plus, 3% more than your peer group or 3% less than your peer group, in really 19 out of every 20 years. Now, what this is also, if you compare X and Y are both lower than your current policy portfolio, Z is a bit more. So if you're concerned about how much you differ from your peers, and if it's a high concern, you might gravitate toward that lower tracking error portfolio. Policy Z is one that's a bit higher tracking than where you are currently. Just to give you, again, a point of reference, the very bottom bullet point, so 2% tracking error, and we ended this based on the data that was available to us in December. Over the trailing 10 years, 2% tracking error would be enough to push you all the way up into the 16th percentile or all the way down to the 77th percentile just based on asset allocation differences, just based on that single amount of tracking error. So lower tracking error reduces that volatility. So, but still, what about 1.5%? That's probably enough to put you into about the 25th percentile or down to about the 70 or 75th percentile with that alone. One thing I'm going to point out is that that's just the tracking error that's due to your asset allocation. You could have, and Jeff made this point earlier, additional tracking error coming from your managers. Now, ideally, it's the good kind of tracking error. The good kind is they're beating their benchmarks. And it's the kind that gives you a better return than the peer group. But it could also be the negative kind. So the more you have in active management, the more tracking error you would have relative to that peer group.
And we're essentially assuming that the peer group is correct in terms of a level of return. I mean, we're almost thinking about it like college football or college basketball when we look at our peers.
I would say the peer group is a very good reference point. It represents a collection of best practices, but not always best practices. I wouldn't say that it is the correct allocation. One thing to note is because it's an average, there's no portfolio that is exactly in line with that. Each of your peers looks a little bit different. And some of it obviously is going to be because they have different target returns. Some are going to have target returns below 7%. Some are still in the high 7s or even as much as 8%. They may have different risk tolerance. They may have different ability or willingness to invest in private markets to take on illiquidity risk. So there are a lot of different objectives and constraints that affect that peer group. I wouldn't say that it necessarily represents the one right choice, or especially not the right choice for you as a group, as your objectives and constraints may be different than that average.
So we highlight it because people ask about it, people care about what their peers are doing, but we wouldn't encourage you just to try to replicate the peers and say, well, if that's what they're doing, let's follow the crowd, because it might not be appropriate for you.
Yeah.
So this is another page that Jonathan illustrated, which was what are the sources of risk in your portfolio? And this is defining risk as that standard deviation metric or volatility in the portfolio. And as he indicated, most of the risk in your portfolio, most of the volatility in your portfolio is coming from equities. And it doesn't matter which portfolio option you adopt, that's still going to be the case. Now, the percentage that comes from equities increases from policy X to Y to Z because it's a higher equity allocation as you move up the ramp there. And the peer average has the highest in terms of a percentage of their risk coming from the equity markets. By contrast, even though you're diversified, the fixed income portfolio, for example, has a very small allocation. And if we broke that up into the rate sensitive versus the credit, you'd see the rate sensitive is almost de minimis. It's less than 1% of the total volatility of your portfolio. And again, this represents an average, essentially a snapshot in time, and that can change from day to day.
Frank, can you go back? Is other credit, or is credit broken down into part rates and part equities?
So the other is that other opportunistic bucket. That's your
Okay.
tactical asset allocation, your risk parity,
So
and the hedge
fixed
fund
income is
portable
in-
alpha. So
is
fixed income
credit.
is that
Okay.
credit
Okay.
and
I got you.
rate sensitive, but it's mostly credit.
Okay. I didn't know if it was rates or
Yes.
everything.
So when we do asset allocation, the traditional tool that's used is known as mean variance optimization. It takes, it spits out, again, using sort of this normal distribution assumption, what are, worst case returns over a given time horizon. The shortcoming of this is, again, as Jonathan pointed out, it tends not to account for what we call in statistics terms, skewness and kurtosis, or more specifically, fat tail events. Fat tails tend to happen more often than are assumed in a normal distribution, and they tend to be more extreme than are assumed in that distribution. So we look at these as a data point, but we look at them with a grain of salt. That we wouldn't say that number necessarily represents that worst case, but it gives you a sense under a normal distribution of returns that this is what it could be. In reality, and we'll see it with some other pages, it could be much more than that. I do like the bottom table there, the probability of experiencing negative returns. This is what are your odds of losing money and I'll use that top row, in any given year. So regardless of which policy option you choose, in about 2 out of every 7 years, you would expect to experience a loss. Now back to the point that Mike made earlier, that doesn't mean you're going to be down 10 or 20%. That could be a loss of 0.5%. But in 2 out of 7 years, you expect your returns to be less than 0%. So we've had a very nice, smooth period, essentially since the financial crisis, but you wouldn't expect it to be quite that smooth going forward.
Frank, can you, is this, as you see it, is this a symmetrical? So if we were looking, it's from 7.4 down to 0 is one threshold. If you were looking at 7.4 versus 14.8,
Yeah.
would you expect to see the mirror of this? Or
Yes, if you use that same assumptions about the shape of the curve, you would assume that in 2 out of every 7 years, your return would be more than 15%,
Okay.
which is essentially right where you end up this year, 14.7 for the calendar year. The next page, again, something else that Jonathan talked about, VAR and CVAR, or value at risk and conditional value at risk. He had a very nice chart illustrating the difference, value at risk, and you can measure it at different confidence levels, 95% confidence, 99% confidence. Here we're using a 99% confidence interval. And you can also measure it over different time periods. A day, a week, a month, a year. For simplicity, we're showing 1 month and 3 months here. And likewise, I will focus on the bottom table, which is the conditional value at risk, the CVAR. And just looking at the 3-month period, because this is a pretty extreme in dollar terms, you could expect to lose, and depending on policy portfolio, but as much as $5 billion based on this measure over a 3-month period. So this is a good sense of sort of worst case scenario. And again, if you recall the math from the chart he showed, this is sort of the average of those fat tail events. The reality is the fat tail could be even worse than that, but this is a good sense for what could that be over a 3-month period. Obviously, policy X, and this is a consistent theme pretty much throughout these pages, is the one that has the least downside, policy Z that has the most, is the riskiest of those three policy options. All right, so switching away from, the statistical measures to something that maybe is easier for people to recall or to understand. We say, well, what happened if you'd have had this policy or this portfolio during a particular historical event? And we pick about 10 or so that go back as much as 40 years. Most of them are equity-related events, so extreme equity or credit events. A couple of them do deal with rising rates. So the first row there is what became known as the taper tantrum, which was essentially rates shot up over a very short time period and equities went down. It was just for that particular summer, and it wasn't an extreme move, but it was enough to move markets down. In that type of environment, you see losses aren't very high, but they are negative. And one thing you'll see is that policy X, because it has the most in rate-sensitive bonds, is the one that does the least well in that environment. Similarly, if you go about halfway down the page, you see 1994. In 94, Fed surprised everyone. Rates went up. The 10-year Treasury went up 300 basis points just in that year. There was a major hit to bond markets. And even though equities did well because you're coming out of a recession, which is really why the rates went up so much, as they were trying to rein in the growth a bit. Equities can do well. Rates did poorly. Bonds did poorly, I should say. In that environment, you can see, again, policy X is the one that does least well. But put it into perspective, these are modest losses, or in this case, very slight gain, compared to, take the very extreme, the second row there, the global financial crisis. Hopefully we don't see a repeat of that, but if we did, that's really the most extreme scenario. And that's the one where policy X does the best, but even still, that's a 25% loss. So it's a good comparison to the prior couple of pages. We were saying under mean variance optimization, the worst case return was 21%. Well, reality is no, it could be much worse than that. Your current policy could lose 27% if you'd had that in place. And again, this is just assuming asset allocation. If your active managers underperformed, then it could be even worse than that. Other scenarios, going back to 1990s, late 90s were a great period that resulted, of course, in early 2000s, popping of the dot-com bubble, cumulative decline of 8 to 10% depending on the policy portfolio. One other thing we like to point out, 3 up from the bottom, is the strong dollar. So what if the dollar moved against you? What if the dollar significantly strengthened? Trump comes out and says, yes, we want a very strong dollar policy. Dollar moves up. Last time that happened significantly was early 80s. Because you have non-U.S. currency exposure, this would be a headwind for you. We tend to be pessimists or maybe very conservative in our thinking, so we take it upon ourselves to include positive scenarios as well in this, just so I'm not always the bearer of bad news. Think of the upside. So most of those popping of those bubbles you saw either had a nice bubble coming up to it or a nice recovery thereafter. So the top row there, the immediate recovery of the financial crisis. And this is just that, first 8 months coming out of the financial crisis was a very good time period for stocks. Coming out of that popping of the dot-com bubble, the year and a half or so after that, or really going into it, were very good periods. Fourth one down, plummeting dollar, so the opposite of that strong dollar. What if the dollar, you get a tailwind? What if the dollar falls precipitously for an extended period? That's something that would be good for your portfolio. The message for most of these is that it's something that is a risk-on period. Policy Z that is going to be the one that does the best because that is the riskiest of the 3 portfolios, not surprisingly. So those are historical examples, but those represent different environments. In 1994, when rates went up, rates were much higher to start with, and we were going through an economic boom. Will that necessarily happen the next time rates go up? Well, maybe, maybe not. So what we do here is model based on current levels of interest rate, current levels of duration, convexity, pricing in the marketplace, yields. What do we expect the impact on portfolios would be? So again, we look at 4 factors here: rising rates, spreads widening, dollar moving against you, and equities declining. So 4 risk factors, if you will. By far the worst is that equity market event. Again, similar level of potential decline from what you saw during the financial crisis. For the spread event, you see not quite as bad, and these tend to be not as bad as your current policy because, as I indicated, reducing allocation to high yield and bank loans, the credit risk. The rising rate environment, policy X, because that's the most rate sensitive, will probably fare the worst of the 3, but again, the downside is not nearly the extent you would suffer during an equity market decline. And yes, a dollar moving against you would result in a modest loss to the portfolio, depending on how much that dollar goes down, 10, 20%, et cetera. The next page is the upside of that. Again, very common theme. Policy Z is the one that does best in risk-on environments. The last section I'm going to go through here.
Can I ask a question there? And this is and ultimately this gets somewhat into implementation, right? When people go through this, they're looking at upside, they look at downside. They don't frequently model scenarios where just kind of nothing happens, like a little bit like 94, right? And because we may be going into something similar, right? Fiscal policy is becoming restrictive, but I mean, monetary policy is restrictive, fiscal policy is expansionary, right? So that's more apt to play through consumers and businesses, and so more traditional CPI effects. And, you got the Fed kind of out there, central banks hitting the brakes, right? But how a portfolio does, if, there we see it's like up 1.9, but an ideal scenario, because that's still a loss against actuarial space, right? I mean, that, back to Ron's earlier question on contributions, still affects contribution rates and pay-in rates. And so really that's a negative scenario, even though on an asset basis it's up, right? And I mean, that's where how you implement your equities can make a difference, or how you implement your bonds can make a difference. I know that's a little harder to model, but ideally, we not only think about up and down, but also the middle, right? Because the middle is an actuarial shortfall, not a asset shortfall, right? Does that make sense?
Oh, absolutely. And we try and walk you through the extremes because they are potentially more interesting, but the middle is what happens most of the time. I mean, most of that distribution is within that pretty tight range.
You're right.
So it is something we look at, and I know Jeff is thinking about when we talk about, over what time frame is he going to increase, say, emerging market equities, or add to TIPS or extended duration of the bond portfolio, if at all.
Yeah, we say it all the time, but markets change in the interim, and how are we adapting our approach accordingly?
Well, and this gets back, I mean, part of I think the challenge educating the board of, all right, where option strategies can help you in that middle, where rebalancing strategies can help you in that middle, right? I mean, that's where, all right, rebalance, but maybe we increase the frequency, or, kind of what's the best approach. I mean, there are different approaches to how to deal with that middle, but I think it's an important question, right? Because, right, if valuations are high, but we're going to get back there by a normalization of rates and by equities and nominal prices kind of being maintained, right? I mean, we could wind up being in the middle for a while, right? But actuarially, that's going to become more and more pressure over time, right? I mean, 2 years of that, and you're 15% more behind, right?
Frankly, on a look-back perspective, that's the story of the last 18 years.
Right.
5.5% for broadly for pension funds.
Right.
You're not hitting your target return, but so it's a real problem.
Yeah.
Extended period of those middling returns.
Yeah, so I would just challenge, in addition to doing this, that y'all, I mean, because it kind of gets into implementation more than asset allocation, right? But I think it's an important question for us to look at.
So the last section I'll go through deals with liquidity. So this looks at your policy and the various alternatives relative to the peer group. And we break out liquidity in terms of how liquid are they on a daily basis, are they liquid on a monthly basis, quarterly, or not really liquid at all. And that's where we put those closed-end funds I talked about earlier. And that tends to be your private equity, your non-core real estate, and your private debt. Now you can see you have less in daily and monthly liquidity than your peer average does. And the main reason for this is your allocation to private debt. The average peer plan is really only about 1 or 2% in private debt, but we see that coming up. It's a trend we see in the industry, as that number has been coming up. That said, ample liquidity with 60% for each of the policy options in daily or monthly liquid assets. But to really test that, we come up with another stress test. It's a pretty extreme scenario. We say, well, what happens if we take these policy options, in this case we just focus on the current exposure because we're not talking about increasing your private markets. What happens if you had a repeat of the financial crisis in terms of the downturn? If you had the extreme downside of 2007, 2008, 2009, all of the bad things that went along with that, such as they put up queues so you couldn't get money out, or redemption gates so you can't get your money out of those private market portfolios. And instead of getting the immediate recovery you had, what if you just had flat returns for the next couple of years thereafter? So what if you have a really bad environment, even worse than we have experienced, and it's an environment where there's really no liquidity? And we modeled the cash flows that are projected by your actuary. So what this shows is that in that kind of environment, the amount you have in liquid assets, daily liquid assets, would decrease. Essentially, think of, if your public equities are down 40%, then the amount you have in liquid assets is obviously going to decrease. But still, even in that extreme environment, you would have at least 50% of your assets that are liquid on a daily basis. This next page shows the changes in asset allocation. Essentially, you could still rebalance along the way, to stay within your target ranges and even back to your targets. Doing so would bring most of at least your liquid asset classes back to their targets. So you could rebalance the bonds and the public equities. What you can't rebalance are necessarily the hedge funds, the private equity, the real estate, et cetera. So some of those illiquid asset classes would drift away from their target, but still within their target range because you have pretty wide target ranges. And that's part of the reason why we have target ranges to account for environments like this. This page probably shows the most meaningful data for you. And again, here we were using September 30th market value. The 29 billion starting point. What happens if, or 31 billion, what happens if after that first year, what happens to your market value? You can see the market value declines all the way down to 19 million at the end of 5 years. If you go to that second to bottom row, how much of that is still liquid? So we'll say liquid on a daily or monthly or even quarterly basis. How much could you get out if you needed to make your benefit payments, to meet your obligations? And the reality is it's still a pretty large number, nearly $15 billion. So you'd still have plenty of money to meet your obligations. But there are two caveats there. The first one is that fourth row down, percent of assets sold in duress. What does that mean? If you had to meet your obligations and you were rebalancing, you would have to sell some of your assets at a loss. And in this case, we say at a loss of more than 10%. So you would probably have to sell some of your equity assets to meet your obligations. And it's obviously something you'd prefer not to do. You'd prefer not to have to sell something at a loss, especially if you expect that it is going to rebound at some point in time. Perhaps most importantly is that bottom row. This scenario, this stress test is so extreme that it's less a test of liquidity than it is perhaps solvency. It says, what is the funded status of this scenario? So you drop from 59, 53, all the way down to 32% funded status. You know, and in that environment, yes, you can continue to meet your liquidity. Yes, you have plenty, we think, to take on more in illiquid assets if you wanted to, and certainly take on, you know, your current amount of illiquidity. It's really just a matter of, you know, that environment is so extreme that you'd have, I think, very difficult conversations with the legislature at that point. Any questions on this before we move on to what in our case is a comparison of the asset liabilities? Yeah, thanks.
All right, thanks, Frank. So the next 9 pages that we have here will be an extension of some of the pages that you saw earlier, and it will be really showing the impact on funded status. So many of the scenarios and stress tests that Frank showed gave asset returns or cumulative asset returns. Some of these analyses will convert that into the impact on funded status. And so we'll do the similar analyses. We'll do historical scenario analyses. We'll do stress tests and everything like that. And so the first one that's up here is on page 3169 in the book. And this is looking at the historical numbers. It's starting out at 59.5% funded status, which is an estimate as of November 30th. And it provides the same exact scenarios. Instead of seeing those percentages, now you're seeing funded status. And so the thing I'd point out is that just like many of the scenarios Frank was showing, you're looking at very similar asset allocations, your current and minor changes with X, Y, and Z, and even peers that aren't dramatically different from you. So just like you were seeing minor changes in the returns, here you'll see minor differences among policy X, Y, and Z and your current in funded status. So no material difference there. The biggest difference is the magnitude of the correction. And so is it just a little taper tantrum like the first line, or is it a bigger one like the global financial crisis? The one I'll walk through is the third one, the popping of the dot-com bubble. And there we look at a scenario like that. In your current policy, you could expect your funded status to go from 59.5% down to 54%. If you had policy X, still goes down, but to 54.7. Y and Z and peers, you could see that as well. And it goes it through for all of those scenarios there. Biggest thing is really, it shows you, the pretty big impact on major declines like global financial crisis and other ones, minor impacts if you're looking at minor events or minor interest rate spikes. Page 32, this goes into stress testing, just like Frank mentioned before. It's helpful to look at history and to say, geez, if we had a repeat of history in any of those crises, what would be the impact with returns? What would be the impact on our funded status? The truth is, it's very unlikely and potentially, you could say, even impossible to have an exact repeat of history. Even if equities hit a crisis, it's hard to say we'd have a repeat of 08 because bond yields are at a different level. So bonds can't behave the same today as they did in 2008 when we're starting at a much lower yield. They can't offer you the same kind of protection. So what we like to do is, rather than just showing history, look at it from another lens. That's really stress testing, where we can control the environment and say, what if interest rates rise 300 basis points? What if equities are down 40%? But that's not down 40% like the global financial crisis. That's down 40% given today's starting point for bonds, for real estate, and other asset classes. And so again, this page here converts returns to funded status. I think once again, you'll see the biggest impact if you look at the line on the bottom, equities declining 40%. Your current policy, 43% funded. Policy X, a little greater protection at 43.7, but you're still looking at a big decline in funded status regardless of the policy option. The next few pages, we have some analyses on a topic called sequence of returns. This is something that you might not have seen before. It's very rarely discussed. I won't spend that much time on it, but we do think it's an interesting one and something worth putting on your radar, having you aware of. It certainly is a risk that many pension funds have. It's something that you ought to be looking at. And, you know, fortunately, you're in a stronger position than some other funds, and you'll see how that plays out in some of the analyses here. So sequence of returns, you know, as the name suggests, is really about how you get the returns. So we have 3 scenarios that we run here. You're getting the same average annual return over a 20-year period of 7.25%. The middle scenario is that you get that each and every year, smooth 7.25% return every year. Obviously not what is expected. The red bar shows strong early returns. That's a sequence of returns over 20 years that has stronger returns in the early years, weaker returns in the later years, averages out to 7.25%. The bottom light blue bar is the inverse of that. It's the same return stream as the strong early returns, just reversed. So you're getting the strong returns on the end, you're getting the weaker returns at the beginning. In all 3 cases here, the key assumption on this first page is that net cash flows are neutral. So cash flow neutral each and every year over the 20-year period. When you're neutral with cash flows in all 3 cases, a $31 billion fund grows to $111 billion at the end of 20 years. No difference whether you had strong returns early or weak return early. I'll skip the tables that give the data and goes year by year, and we'll move ahead to the next one, which shows the negative impact if you have negative cash flows. And for many plans, they have negative cash flows and significant negative cash flows. And if they hit a crisis, they could be in a situation where they might never be able to recover if they had strong negative cash flows early on and a significant negative return situation. Fortunately, you're in a situation where the negative cash flow is relatively small. And we'll show you how that plays out, but it still has a pretty significant impact depending on the sequence of returns that play out. So here again, 20-year returns. If you look back 20 years from now, you say, okay, we got 7.25%, that's exactly what we wanted. However, if the 20-year returns of 7.25% are with the strong early returns and then weaker at the end, the red bar ends up at $89 billion. Whereas if you get smooth 7.25% returns, it's $82 billion. Or weak early returns and strong at the end, $68 billion. So that's a $21 billion difference. We're talking about a lot of models saying 7.25%. You're making a lot of assumptions based on 7.25%. This is just changing one variable that people almost never talk about. Well, does the sequence matter? If you have negative cash flows, it does, to the tune of $21 billion over the 20-year period. The next page gives the line-by-line detail, but the last one I'll show you then is just the impact on funded status. So here again, we're converting the returns to dollars and then into the funded status. And you know, the light blue line on the bottom puts it at 93% funded status. The red up top, 123% funded status. So here you're having the same returns, but if you have the strong returns early on, it would play out to be 123% funded, overfunded, good position, able to reduce contributions, discussion everyone would love to be in 20 years from now. Or if it's, you get the 7.25, but with weaker returns early on, combined with the negative cash flow, 93% funded, still looking at it saying, okay, what do we need to do to get up to 100% funded? We bring that up because most studies don't show that. We just wanted to let you know there are a lot of variables and a lot of assumptions in the models. We talk about tracking error, and you could choose the same asset allocation or an asset allocation that has the same expected return as a peer, but with different components to it. You expect to have tracking error. Active managers on top of that provide tracking error. Here again, we're talking about another area that changes things, and that's a sequence of returns.
So I just wanted to ask, and I was trying to see if I could determine that from your data slide. So how much are you projecting in these returns up front? How many years and how much excess returns
Right.
or deficient returns? And the reason why I ask that is it was a significant part of the discussion that the Joint Pension Committee had in establishing the contribution schedules going forward. They did look at trying to take into consideration lower returns up front and even modeling a 7% return long-term versus the 7.25 to try to make sure that they were conservative. So I'd be interested to see how much of a difference you're using in your slides.
Right, yeah, and so here, these are the, yeah, so the bottom two lines, and you could see that in the first year, the strong early returns, you see it. What's that?
I was just noticing that it's not a static return for 5 years, then changing it. It's trying to mimic
Markets,
mean
exactly.
variance, environment, but just one that's positive early and one that's negative early.
Yeah, exactly. So we talked about taking historical ones here. It's harder, though, to match historical numbers to get your 7.25. But so you could see here the strong late returns, you're starting off weak, -20, -11. And then we threw in some modest returns, 7, -4, -10. So that is a weak environment. It's not as weak as the stress test that Frank ran earlier. But it might be a weaker scenario than some other models. It's hard to fully account for it. And so even though adjustments might have been made here, the opposite side, the positive side, if it's the strong early return, starting out with 10, 28, 7, 2, starting out that way is a big advantage. And so that's one of the reasons that you can get to be overfunded if we're fortunate enough to have the strong returns early on. So, yeah, these are the assumptions right here. We could build it any way to get to 7.25, and we just tried to have random volatile returns across the period, but that produce the differences. And, and the truth of it is, I think that's what individual retirees deal with when they're talking about not having a pension plan, but trying to plan their 401k and wondering how much money will I have in retirement. Well, it really depends on the sequence of returns. And you talk about, and you've seen some studies where some retirees that retire at a certain period and the market has certain returns are able to withdraw much more money out of their accounts to support a different level of retirement than a different scenario. So some of this is basically saying we're not sure if we're even going to get 7.25, but if we do, we're not sure of the path of that. And it does have big implications. I think it's helpful that it's modeled in there. It's hard to model it fully. You'd need to be really conservative to model it fully in there. And then you might say 5 or 10 years later, we didn't need to be that conservative. Why did we put that much in? So it's a tough one, but it's to precisely do it. And that's why we can look at this every year with you to see how it's tracking and what the next 20 years look like.
And then just one follow-up question. The difference in 7.25 and 7 seems very small, but how much does that shift? Just a nominal amount over on the bell curve? If you were to run those models, like the probability of achieving 7.25, if you changed that and kept the current allocation and the allocation for the proposed portfolios, how much would that change, that probability change, if you were reducing the expected return? from 7.25 to something lower? If it's just 1/4 of a point, or do you have to really move that half
Yes.
a percent or more to make it move very significantly on the bell curve?
Yeah, the short answer is you have to move it well below 7.25 to do it. And we model many of those internally. We work with staff on those. We can show you more of those in the future. But to get to a scenario where you're looking at, 80 or 90% probability, you really need to lower the return significantly by a few points, or dial back to the 1980s when bond yields were at 12%. And you literally could have a 60% equity, 40% bond portfolio that had significant double-digit expected returns and well over a 90% probability that you'd hit 7.25. But that's where a lot of people would like to see interest rates gradually rise, not so much, as Jeff said earlier, that they disrupt the equity markets, but a gradual increase in interest rates would be very helpful for pension funds.
But Peter, we did talk about the chance of not necessarily exactly to Peggy's points, but we did talk about the chance of, if you look at that kind of dispersion, the probability of hitting, say, for at least 6. I mean, there's the probability is what, either, I can't remember if it was, I think it was at least 2/3 or 67%, I think, probability that your returns would be at 6, or your annualized returns over that time period would be at least 6 or better, right?
Right.
So, yeah.
Thank you.
Okay. And so there's one last slide we were going to cover here, and it's on page 39. This is just the final analysis that we're going to cover. This is a stress test, and it shows the impact of a 25% equity shock, and it converts it again here into funded status. The key here is it talks about the amount of time it takes to recover from shocks like this. The takeaway here is that the recovery period is much quicker if the negative event happens further in the future. Because then the fund is in a stronger funded position. And so we walk through it. So, for example, the first line, year 0, so if it happened immediately today, a 25% shock to equity markets, this is starting out with 56% funded, would immediately go down to 45% funded. It would take 9 years to recover just to get back to where we were today, with to a 56% funded ratio. Take 13 years to get up to a 66% funded ratio, 18 years to get up to 80% funded, and 22 years to get up to 98% funded. If that shock occurred in year 5, only takes 2 years to get back to 56% funded, because you've had 5 years of 7.25 returns building up and increasing your funded status. That combined with the additional contributions that are happening, moving you to a greater funded status. And so all the way down to, I won't go through every line, but down to, if it happened 15 years from now, you'd be 98% funded already 15 years from now if you're getting 7.25 each year. It would bring it down to 81% funded. So the recovery period back to 56, back to 66, back even to 80% is not meaningful, not applicable. You're there already. Even with that kind of shock, you're still at 81% funded. It takes 5 years, though, the bottom right number, to get up to 98% funded from that shock. And so, this basically, says a lot of the things we're talking about doing are, glide paths with getting 7.25. A shock at any point is difficult and sets back the timetable. If it happens early on, immediately or in year 5, it's more difficult, more painful than if it happens in year 10 or year 15. So this tries to illustrate that as well, because many of the analyses that we and staff do, have certain assumptions, and they say, well, what if this happens? So we're trying to now show some of the what ifs, just because in reality, it's hard to assume that you're going to get 7.25 without disruption. So there's additional materials in the appendices. Many of those we didn't plan on covering here today. Some of them are ones that came up at prior meetings or on phone calls. We thought it would be helpful to run those analyses. We discussed them internally and with staff. We've included them in here for many of you for references. But we were going to stop here for planned comments. Happy to handle any questions on what Frank covered, what I did, or any other issues.
Just as a point of reference, could you approximate what the expected return would be for a 70/30? I think that was covered at the December meeting, but I don't have it in front of me.
Oh, yes, and I'll see if I have that in one of the appendices. If not, I have December materials that I could pull up separately, and I might have to get back to you in a couple of minutes. So,
Just as sort of another point of reference, on page 10, looking at the expected returns of the current and the proposed alternatives.
questions on page?
In other words, just as another point of reference for the expected return page.
Okay. Yeah, so I don't have it in the book right here, but I could pull up some numbers shortly, and share those. And so we did, some of the analyses that we did were, what if it were all liquid, public equities and public bonds? What would the return expectation be there? What if it were all U.S., all dollar denominated? What were the return expectations? And those analyses, I think are helpful to look at to say, well, what are we getting for going outside of the U.S.? What are we getting for diversifying into less liquid asset classes? And the conclusion from some of those figures, without having them in front of me right now, though, but the conclusion there was that there was a significant return give up, that we certainly appreciate the diversification component of investing outside of just U.S. stocks and bonds. But even from a return perspective, there was a pretty big return give up. I'll pull up the stats, can share them shortly for some of those scenarios. But by only investing in the U.S., it was a big enough return give up, and also only investing in liquid assets.
Yeah, and so basically, we can't really consider those because they don't reach 7.25.
Well, Ron, at the last meeting, we looked at a 65-35, so if we're okay with that.
Yeah, that's okay.
As the surrogate, at that point, it was 6.8.
Yeah.
Assume that forward expectation has also fallen.
Probably about 6.6.
Yeah. So those are really outside options we can consider. Even though we might like the risk better of those, we can't really consider those, given our constraint of 7.25.
Right.
Jeff, what was the vol on that?
At that point, 12.4, and I'm flowing through all kinds of scenarios, so I don't know how that would have changed in the forecast as well, but to this meeting.
Yeah, so I would point out two things. Number one, it's hard to realistically consider that if you're looking for 7.25. But on top of that, I think it's dangerous to only be invested in U.S. as much as we might go through a period where the dollar's strong and it feels like it's painful to be diversified into non-dollar assets, or where the U.S. stock market is the strongest in the world and it feels like diversification into other stock markets that underperform it feels painful. We could go into a period where, a 5 or 10 year period where the dollar's weak and it's really valuable to have some non-dollar exposure. Or we could go into a period where the U.S. has one of the weaker performing stock markets for an extended period. And the diversification would be really valuable beyond just helping to get to the 7.25, just diversifying to protect from certain cycles that might be out of favor. And I think investors in Japan that were not, and then have not been globally diversified for the past 30 years have paid a big price for being just focused on their domestic assets.
Maybe just to kind of highlight the impact of that, and Peggy, you'll be able to do this much better than I can, but it's my understanding, like, just from lowering the assumed, so we went from a 7.25 to a 6.6. just lowering the assumed rate of return from 7.5 to 7.25 was, to SCRS, was what, like $1.3 billion?
I don't recall
Impact,
exactly what it is, but it was well over $1 billion.
yeah, impact to the unfunded liability and required what, in and of itself required 100 and something, like 110 or so $1 million contribution increase in order to fund that difference. So, and the way that I understand it is, the lower the assumed rate of return goes, it's not arithmetic, and the impact on the contribution.
parabolic.
Yeah, it's parabolic in the way that it's not, the contribution increase going from 7.25 to 7 would be more than what it was to go from 7, and so forth and so on as you drop quarter points, right?
And we provided to the Joint Pension Committee a variety of options along those lines, dropping it from 7.5 to 7.25 to 7, all the way down to, I think the lowest one we did was 4%. But the model that the General Assembly chose to base the contribution rate increases on was an assumed 4% each year for the next 5 years, and then a 7% going forward, even though in statute it said at 7.25. So they built in some conservative provisions, and what we are planning to track for them is that projected run out based on their assumptions that are attached to the bill and actual experience. So for this past year with a 12% return, that was well over the 7.25% that's set in statute, but even more above the 4% that they used in their projections in setting the contribution rates. So, you know, we will keep track of how much greater progress we make given those better returns
Yes.
up front, you know, versus later on, even with the same long-term achieved rate, average rate of return.
I just think it's, you know, important for us to highlight, you know, as we go through this, that the consideration of, you know, why do we have this, you know, which would be a little bit more complex, a little bit more expensive portfolio, what's the cost, what's the benefit of that? And, you know, if you're a much more simplified approach, although it may be easy and attractive, and, you know, you get the feeling of paying less in fees and you have less complexity and more liquidity, there's a trade-off to that, and the trade-off is significantly more, and projected over the, you know, next 20 years would be significantly more in contributions. I think so I think it just need to be mindful of, and also, you know, attempt to create the understanding that it's not that we're just divorcing ourselves from considering something that would be, you know, a much more indexed style portfolio, whether it be a 65-35 or 70-30. It's just that we don't project that we get the enough return to make the plan work. I think that's the important key for us to, it's not that we're not thinking about that, it's just that we feel that there's a cost-benefit analysis or a cost-benefit reason as to why you have a portfolio like we do.
And as the contribution rate increases for employers significantly, as it is in statute, that becomes a much greater discussion with our employers on how are we investing. And I think that the commission, and I think Mike and Jeff are doing a good job of that, you know, in talking with our stakeholders, is making sure that our stakeholders understand the risk that's associated with the asset allocation that we use, because there is that trade-off on contributions. If you just had unlimited contributions and you could set that wherever you wanted to, you would want a much more conservative portfolio perhaps, but that trade-off is something that's very difficult to balance.
I think we're bumping, you know, with where the contributions are going, I think from a public policy standpoint, we're bumping up against about all that especially the locals can look to afford, I think, you know, in that regard. So I think we have to be very mindful of that and thinking about portfolio construction as well, so.
Do you mind, can I ask how you modeled the cash flows here? Does it actually use actuarial data?
It does.
Okay, and then it looks at the statute's proposed increases in contribution limits, and then once that hits like 100, the decreases, et cetera, that will, yeah.
I don't think that the data behind this, I don't think considers, you know, because you get 200% funded in this. I don't think that contemplates the formulaic way that you would expect the contribution rates to adapt to being 200% funded. I think so. This is using the expected cash flows that would be tied to that thicker blue line, the center line, right? So what color is that? Is that a red line up top?
Yes.
That's playing by the same rules as the blue line and the same rules as the lower performing line.
Right.
Whereas if you were in that red line and we wound up at 150% funded, the contribution rates will have already, years before, gone back to normal cost. So that's not, I mean, it's not, you have to, when you're showing the three, I think you have to have a uniformity, but there's a reality that would creep in to the lines that are not the blue
Right, I
line.
didn't ever think that we would actually
Yeah.
be able to get to 200% funded
Yeah.
status. So,
And they would continue
Yeah.
with, these elevated contribution rates
Right.
while we're there.
Yeah.
Would not be the
okay.
probable outcome. Is that a fair?
That is
summary?
fair,
Yeah.
exactly. So we've modeled the exact cash flows that your actuary gave us, but did not model in any changes in contributions that would happen if you hit certain funded levels.
Well, but I think one of the things you can potentially draw from this, though, is, and it's not that you can necessarily see the lines as clearly, but under the statute now, the contribution rates can't start coming down to where 80% funded, right?
85.
85%, that's right, 85% funded.
And there's a lot of discussion about whether that gets changed at 85%
Right.
or whether it gets changed at 100%. I think that's another point that the Joint Pension Committee is reviewing.
But you can kind of almost superimpose over that a thought as to when do we get, based on the sequence of returns, when do we get at 85%? And the point at which those contributions could come down. So sequence of returns has a significant impact on when we could start seeing those contribution decreases. Because you can see that is one thing that you can kind of see from
Right.
that is if you could draw a line, if you draw a vertical line at 85% funded on both of those, you could see the difference in years between the time period. So it's a significantly longer, based on sequence of returns can draw out the amount of time before you can start lowering contributions as well. So,
Right.
yeah.
So even if you used 100% before those rates changed, what would happen under that red line scenario is once you reach 100% funded, then the rates would drop to normal cost and it would be split equally between the employers and employees. Normal cost for the plan right now is about 10.7%. So they would share equally in the cost. And if negative returns pushed you below 100%, then they would increase equally
again.
as well.
I mean, I'm just sitting here thinking though, like from a funding thing, right, the contributions are much more certain than my market returns.
Right.
Right, so I'm sitting here thinking, well, why wouldn't you sell off the scenario that gets you at 100 and then people start monkeying around with contribution rates and truncate the one that's gonna be a political storm, on the downside, right, out at year 7. I mean, this gets back to kind of option strategy, but I'm sitting there
Yeah.
looking at it going, well, why would we trade off a uncertain one for a certain one?
Right.
I think that's
in that
part of
scenario,
the evolution
right?
of how you talk about risk.
Yeah.
Right, not just portfolio risk, but
Right.
system risk as well.
What's the value
So-
of the certainty of returns to the overall stability of the system, or
Correct.
bringing in yeah.
Yeah.
Well, if we were 100% funded, our whole discussion today on asset allocation and risk would be, it would go down a very different path. So if we got to that point of being 100% funded or close to being 100% funded, the way we view risk and that trade-off between, contributions and return and risk would take a very different path.
Oh, absolutely.
Right, but, I mean, that's where options come in, because that whole top of the graph, you can sell off parts of that. Right?
Exactly. I mean,
Today,
that's where
right?
a lot of plans strive to get to be more fully funded so they could then say, let's get more conservative so we could retain that full funding position.
Right.
And, and so that would be a great position to be in, to have that as an option, to talk about that.
Okay.
Yeah, we'll be.
We can dream.
Hopefully some of us will still be here when that happens.
It'd be great if that were year 8, wouldn't it?
Yeah.
Well, so, we point this out is because it's not frequently discussed. We want to put it out there that, and point out if we have weak returns early on, that it is even worse than the baseline case. But, the positive news, all of these things, and we don't spend enough time on the positive side. The positive side is if we have the strong returns early on, it does put you in a more favorable situation than the baseline. And, in this first year, as everyone was pointing out, has been a strong year, and then well above the even more conservative assumptions. So it is a nice way to be starting out ahead of baseline assumptions.
Thank you. All right. Frank, do you want to bring us to a head here?
Yes, Madam Chair, that essentially ends our prepared comments. We do have one final page, which we call recommended page, page 41 here. Essentially says we've got 3 policy options we've put forth. We're comfortable with any or all of the 3 of them. We entertain any further questions or discussions you want to have about them.
Well, I really want to thank you. I think we have seen things here that we've never seen before, and the way you presented it, I think, has really helped with a lot of comprehension and unfortunately added a whole many more dimensions to our decisions. So I'm looking forward to discussing it, but I was wondering if anybody would like to take a break before we do that. Okay. Okay, so let's adjourn for, let's say 5 minutes, and it'll really be 10. How's that?
Get started, Madam Chair. Can I make an introduction?
Yes, you may.
Thank you, Madam Chair. Josh, would you please stand up so we can get a good look at you? Ladies and gentlemen, this is Josh Rastari. He has recently joined our analyst trainee program. He graduated from the Indiana University of Pennsylvania this past December. He grew up in Pennsylvania. He was while he was at IUP, he was part of the Business Honors Program. He's interned at Stewart Capital, and we're just very lucky to have him and look forward to getting as much work as possible out of him. So, but please welcome him to RSIC as the newest member of our analyst trainee program. Thank you.
Welcome. Thanks. Glad to have you here. So, thank you. I'm always delighted to see new faces in our analyst trainee program. As we start back, I was thinking maybe I would love to hear from Jeff on sort of his thoughts on what we've just covered. And
Happy to. I think they've done a lot of really good work, and it gives us a different perspective than what we've seen before. When I think about the different scenarios, my personal preference is policy portfolio Y. But again, like Frank, these are more birds of a feather than what we looked at last time. So we put together 3 portfolios that each of them has its own merits and potential issues. But I think that what makes me prefer portfolio Y is I like the notion that we are reducing credit exposure and slowly adding to our equity exposure. I'm not as excited today, even though I think that what we talked about with respect to core bonds last time is an important concept, and it's something that I think makes sense in a very long period of time. I'm not as excited about the use of long treasuries as we sit here today. I view that as a different risk, but one that is not does not carry its typical reward. So that's these are some of the factors that I cause me to prefer portfolio Y. I'm happy to answer any questions, but and also I want to thank Frank who had the unfortunate task of responding to my constant idea flow around what we might want, how we might want to tweak something or how we might want to think differently about something. But so Frank, I think, had the short end of this. But thank you for the work that you did.
Does your preference include considering the current policy? Or just the three alternatives? that-
Yes, so
that
what-
Nikita presented.
Yes. What I would most like to change about our current portfolio is a reduction in credit. I think of, call back to the left skewed tail of that we saw in Jonathan's presentation, and I think that's where we are with credit today. Very limited upside and more appreciable downside. And I think that's my job, is to expose us to the risks that are going to be properly compensated over time. I don't feel that in the near term that's a great place for us to be concentrating risk. And that is one of the principal ways that we do look different. We have for years used more credit exposure than our peers and less equity exposure. We have a very long-term time frame that we think about risk over. But at the same time, when you believe that you've sort of gotten all of the juice out of the orange that you're likely to in the near term, I think it behooves you to recognize that and think differently about the current implementation. So I hope that's helpful.
So that you would prefer Y to the current?
Yes.
If it would be,
Yes.
if you were choosing today?
Yes.
But would you recommend changes to Y because you mentioned long-term treasuries?
That is not a portfolio that employs a significant increase to the Treasury investment. So that's something that, we spent a lot of time talking about, Frank and I, and Aaron, who's not here today, but that's a perfectly valid concept that we need to consider, but I would rather we consider that at a point when those prospective returns are more compelling.
So what would because under policy Y, we're adding 1 percentage point to the treasury, long-term treasuries, and then
Well,
the intermediate flash.
Treasuries, yeah, it's going to
then-
be intermediate.
Okay, intermediate, and then 2 in tips. So
Yes.
like, what would be your anticipated glide path for that?
I don't think that we have to, these changes are not so extreme that they require a lengthy glide path. I think that we could do it either, these are changes that we could execute, I think, between now and the end of the fiscal year. I'd like to be thoughtful about whether or not we want to stage it maybe over one more year. But it is not something where we would have to do so. So perhaps, I could come back with an implementation plan at the
Okay,
next
so-
meeting.
But it's something you
Yeah.
would think about
Yeah.
and develop an implementation plan for.
But essentially what we're proposing changes to are more liquid markets. We are contemplating an additional 1% to real estate. That would be one of the slower pieces to this. So. Greg, did you have anything you'd add to that, other than agreeing with what I said?
Absolutely agree. On a side note, Aaron's wife just had a baby girl last night, so that's why he's not here.
Fantastic.
Congratulations.
Cheers to him.
That's wonderful.
I didn't mean to imply that you guys didn't allow him to come up.
And it looks like in policy why the 2% change in the public equities, it's all in the option-based equity. Are those typically, do we have those in U.S. equities, or how
Yes,
is that?
that's an alternative to S&P 500 exposure in our current implementation. So it's a lower risk form.
Right.
Kind of the principle there. I believe that,
One of the strategies has a little Japan in it.
yes. And the other area that we're interested in is emerging market equity.
Right. Moving some from the.
That is
non-invest.
a more volatile form of equity, so think of those as having a little bit offsetting characteristics.
Jeff, earlier on, somebody mentioned the foreign currency exposure and hedging. And how do you feel about that at the moment? I know historically, we've seen all this stuff that over long periods of time, it kind of evens out. But obviously, during
Yeah.
shorter periods, you can have some extreme volatility. So, and how are we handling that?
I think you've said it right there. It's something that I don't think we would contemplate from the perspective of it adding to our returns. The question, I think, is more of a risk question. Are you getting rid of a volatility that, on the one hand, it offers you, in the fullness of time, little to no compensation to get rid of it, but does it do something from a risk perspective that you find compelling? So that, I think, is the threshold question is it attractive enough from a risk perspective to introduce that level of complexity to how we manage the plan? I was very much against it when it came up 3-4 years ago, because I didn't want us to be making a decision based upon recent pain from the dollar strengthening and thereby devaluing the non-U.S. assets. So now that we've had a return of some of that, or an inverse of some of that pain, I think now we're in a period where we can have just a discussion about it and have a strategic discussion that's not a reactionary discussion, and that's why I think we do this now. I don't think we don't want to be evaluating it and overly influenced by recent significant value nor significant pain. I think we want to have a long-term strategic discussion about it. So, and I think it's an important conversation to have. I don't think that we will find it to be as compelling because there is complexity to hedging this that we, the staff, will have to understand what does it ask from a liquidity standpoint. There are considerations that aren't as simple, but I think part of that is also we would need to say, if we were going to do it, this is how we would do it, and kind of bring that into the discussion as well. So I don't think that when we sit here and we think about asset allocation, hedged, unhedged, I would be surprised if you all had a dramatically different forecast for developed market equities, whether hedged or unhedged. So I don't think we're having a return conversation. I think that we are simply having a risk conversation about it. And we do need to layer into that as well, because we do care. How does this make our performance differ from our peers? And I have not seen, I would defer to Frank and Peter, I have not seen a lot of our peers highlighting the importance of hedging their currency risk. So, I think that I think everyone goes through this exercise, and I think what we should just come out of it with is, some principles around how we think about currency hedging. So there's a long-winded answer to a question that I didn't need to do that to you with. So, apologies.
So, bottom line is,
I don't think I would do it,
yeah, okay,
but I think we have to look at it.
okay.
Anybody else have thoughts or discussions or questions for Makita or for Jeff?
Well, this is kind of a macro question, but we're hearing a lot about equity returns over a longer period of time, and historically, I think the right numbers, since 1928, we've had this 7 to 8% return of equities, including, I guess, dividends, something like that. However, there are an awful lot of people now saying that is not something that we can count on going forward, would be more like 4 or 5%. But given everything that's happened here, you know, with taxes and the worldwide recovery and economic progress and so forth, why would the expectation for such a lower return be reasonable at this point?
Short answer is pricing. If you assume that stock markets revert to some sort of historical mean, let's say a mean of price earnings ratio, and let's say you cyclically adjust the earnings piece, right, so that you're not taking into account the 2007 to 2008 period. A really popular measure is the Shiller PE ratio. It looks at prices relative to inflation-adjusted 10-year earnings. And we don't have any charts in our book, but we have ones we can show you in the future that show you the link between, the current level of pricing and the returns over the next 10 years. And there is a very definite relationship between those. The more expensive stocks are, the lower the return is on average over the next 10 years. And we're at a point now where we are in the most expensive decile of pricing for stocks, based on that measure anyways. That's just one measure. And historically, when you've been in that, the returns for stocks have been certainly lower than historical average. In some cases even, and that's on a 10-year projection. So looking out over 10 years. So that's the argument for why, yes, you would expect lower returns going forward. So this is one good measure. So the bottom right is that Shiller PE I was talking about, the relationship between that and the returns over the next 10 years. So if they're expensive, returns tend to be low or negative. If they're cheap, returns tend to be high and positive. The counter argument is that things are different now. Maybe a higher percentage of economic activity is going to profitability. Maybe instead of all of the earnings being paid out to dividends, a lot of it's being used to buy back shares. That there are things that are changing the way the market should be measured. Maybe it's when interest rates are low, it justifies paying a higher price for stocks. There are a lot of reasons that I've heard to justify a higher price going forward.
Having said all that, if you accept that argument, does that then validate an argument for fixed income if the progression of rates continues on the trajectory that it is at? In other words, it's entirely possible that we might get to, in another year, 18 months, 2 years, we might be at 4% on the 10-year bond. Well, if we're only looking at 4 or 5% returns in the equity market, 4% in treasuries doesn't sound so bad.
So, Ed, I think one thing that I would tweak to the question is, I don't think this is a question solely about equities. It's a question about risky assets in general. Bonds are expensive, stocks are expensive, credit spreads are tight, means they're expensive. So this is a world. So I don't take it lightly, by the way, that one of the changes that's modeled here is an increase to equities, because it's hard to feel great about increasing your exposure to equities when they're expensive. So I don't mean to jump in, but it's not just stocks where there are low forward expected returns relative to history. It's risky assets in general. And I think that you have to think of this as an effect of the low cash rates. Cash rates fall, and slowly the treasury curve flattens. It falls, then flattens. PEs rise, meaning the forward return expectations for equities are falling. It's really just a function of kind of bootstrap off of a low cash rate. And the traditional relationship between cash and bonds is you get 1% to 1.5% in excess of cash. That's consistent right now. That's kind of where we are. Then you get an additional return for equities, but because we're starting with really nothing in that cash rate, fortunately it's coming up. But the forward returns for all assets are not great right now. But this is part of how things ebb and flow.
But that's where cash flow management's so critical, right? Because, I mean, if you have expensive prices, there's three ways to get back. It can fall. You know, your cash flows can out-earn it, right? So it can either be flat or go up at a slower rate, right? So you get convergence between value and price at some future date, where your currency goes poof, right? And we're seeing some combination of all three of those at the moment, right? I mean, we're hoping we can transition to more earnings-driven versus rate-driven, but that transition is leading to falls in prices, and to a degree, we're seeing our currency go poof, right? Against different things. And so I think managing, that's where these middle scenarios and that path of returns is so critical, right? Because you don't know which of those three it's gonna do at any given time, right?
If you're trying to make some assumption on rates, how much validity do you put into the traditional formula of predicting where, say, a 10-year treasury should be on the basis of where nominal GDP is added to inflation? I mean, if you take that right now, we would be at a considerably higher, should be at a considerably higher rate. But I mean, is there still some validity to that formula?
My personal bias is to look at market pricing and to say, what is the market predicting? And, you know, we were talking about this yesterday. One way you can look at it is say that the futures curve, when Bernanke was chairman, one thing he always talked about was the 5-year 5. You know, what is the 5-year bond rate in 5 years? Because that's really saying, well, that's where we think, you know, yields are going to be. That's where we think markets are going. Now, that I would say is your best predictor, certainly not the only and perfect predictor, but the best predictor of where rates are going to go. You know, getting back to this, if I'm looking at not just rates, but actual return expectations, the yield on bonds is a fantastic predictor of the return you're going to get over the next 5 to 10 years. Like the best predictor of any asset class we have. You know, see a correlation there, 0.76. I mean, the nice tight fit up and to the right, very low distribution, especially when rates are low. And if, what do we say, 2.85 is where the 10-year is?
Yes.
That's a pretty good idea of what you're going to get over the next 5 years if you hold it.
So let me juxtapose that a little bit against, you could just look at what is the Fed itself expecting to do and let them set the front end. And then you assume some shape to the curve from that. So if the Fed does what is expected, what their sort of the dot plots expect that they're going to do, you're going to see, I don't know if it's 5, 6, 7 rate hikes over the course of the next 2.5 years. So if you just allow that to serve as your expectation for the front end, you're going to see the front end go 1.5 to 3. This plan works a lot better with the 3% cash rate as the basis upon which all other asset forward returns are bootstrapped than it does, where we've been. But the problem is the migratory path from 0 to 3 in cash rates can be very painful. Right now, we're fortunate for the last 12 months to have rising growth forecasts globally. So that's a nice backdrop, that they have to try to move that up against. Because what you don't really want is falling growth, rising rates, and you run the risk of your horrible outcome in the 80s, the stagflation scenario. That type of outcome can be obviously very, very catastrophic. So, I think we have a thoughtful Fed, but if you think of 3% being the front end, add a point and a half for the term structure of the curve, add a few percentage points more for equities. We have some private equity, things like that we expect a return above that from. It's a lot easier to see how the plan works. And that's part of the forecast. The cash rate embedded in all of this is not what it is today. It's a higher cash rate. So there's some of this that's forecast, but, just like we think about the sequence of returns in the markets, what is the sequence of these things happening?
So, on that point, what are tips telling you here?
Well, you think about tips. Tips are helping you look at the difference between nominal bonds and tips, and it implies an inflation rate. So, and I wish I had Justin in here. I don't know exactly where the break-even inflation is. That's an inflation rate that makes the pricing of nominals and inflation-protected securities logical against each other. And I don't know exactly what those, the 5-year inflation break, even the 10-year, I don't know what those are, but it's still relatively subdued, certainly versus history, but it's been rising
But it's still
recently.
pretty low.
Yeah, low by historical
About 2%
standards.
it's been recently,
Is that
plus or
where it is?
minus, 10 basis points.
So I think if you were thinking about risk, you'd probably, if you think historically, you'd say that there's probably some risk to the upside to that, but that you'd be not paying attention to exactly why is it 2 today. So I don't know that I'm advancing
Yeah.
the ball here. So.
Okay, well, so we're at a point where we could make a call, or if we feel like we want to push it off and think, or have more discussion on it, we could do that too.
Madam Chair.
And you can,
We have a portfolio today
yes,
that is, not lacking. This is just simply if we think it's compelling to make changes to that. So I don't want it to look or feel like we have to do something, or else we're somehow impairing our, ourselves in the future. So we can always, I think,
Choose to do
as Mike and I
nothing,
think
yeah.
about this is a conversation we can have any time of year.
yeah.
It's not this is strategic asset allocation, so
Yeah.
this is not we're not necessarily bound by any particular deadline. So,
Yeah.
we're gonna have to adopt an AIP before, but that's, as I said, I think we need to try to get in the thought process of kind of divorcing those two topics anyway.
Right,
From
right.
an annual asset allocation discussion and an adoption of the AIP anyway.
Rebecca, is there
so.
any reason to hold off as opposed to picking one of these scenarios today?
I think we go ahead and vote.
I would go ahead and do it, yeah. Just to be perfectly clear, that last one, was it Z? That's one where we pull back to some extent from fixed income?
One that has most equities.
Yeah, it's
It
most
has
equities
the most in
unless,
equities, but also the most in core fixed income as well.
but reduced
Credit to
overall reduced fixed income. No?
Overall, it goes up from 12 to 14% fixed income.
If you include credit with that.
In-
yeah.
Oh, okay.
So credit down 4, core up 2.
It's adding the most equity, which I think would suggest a longer path to implementation. I'm not a fan of making a very large shift, at a single point in time for, of 4% for equities, I think was the increase.
Public equities, yeah.
So that would, I think, suggest a longer implementation plan, but, we shouldn't worry about the migratory path. I think this is about where we want to wind up.
So I don't want to put words in any motions, but I'm thinking that since people have indicated that they are interested in voting, and Jeff did indicate a preference for portfolio Y, which I think other people have sort of agreed with him on that perhaps we frame this as we have a motion to adopt policy Y, and then we can vote on that one. Does that sound okay with everybody?
Sure.
Frank, would you mind to turn to page 10? Whoever has the clicker to turn to page 10 of your presentation, or I guess 40 would be, yeah, okay. so
So
that
just to
some of-
refresh
yeah, so
everyone's
everybody's-
memory as to what
everybody's
policy,
doing the same thing.
it was the not too hot and not too cold policy.
Given that we put the benchmarks in the right motion, you want to clarify that we.
Madam Chair, I do have a question, and I just wonder if it's right
Yes.
to bring it up now or wait for discussion on a motion.
I say go ahead, let's just get it all out right now.
All right. I've just, you know, and maybe it's just being a new commissioner, I'm still working through some, maybe even some higher level things here. Are we bound? I know we're not the only cog in this wheel by any means, far from it. But are we bound to adopt a plan for 7.25% or better when we didn't even set that rate? You know, if we were just managing somebody else's money and who weren't bound by contributions and things like that, you know, we might not adopt a 7.25% plan. So what I'm really getting to is does all of that affect our fiduciary duty? Because if I was just a regular investment manager, I might not adopt this plan. But should I build in, as part of my fiduciary duty, should I build in these other constraints and these other needs and demands and abilities or non-abilities to pay? And so that's what I'm struggling with, especially when I see a 50% probability of making 7.25% with these plans, even our own, and even the peers are not far from it. You know, so I'm still working through that, which affects whether I can adopt a 7.25%, any 7.25% plan.
Do you want, yes.
Yeah. I think that's an excellent point and an excellent question. And I think it's something that we have, quite frankly, have internally struggled with as well. We have had, butted up against reticence with our prior experience to take, even for to be recommended that we take that into consideration as to whether or not we should aspire to achieve the assumed rate of return. The way that, and this is just the way that I look at it, I think that the 7.25%, I think, informs our fiduciary duty. And I think that it is part and parcel of, because that is, in essence, you know, that's the assumed rate of investment return. It's set ultimately by the people who backstop the plan, which is the General Assembly. And I think it informs our decision on how we should attempt to allocate the assets, and taking into consideration that ultimately that rate of return is what drives that rate of return is what drives the plan. You know, drives contributions, drives, you know, the amortization schedule, drives basically everything for us to maintain, to be statutorily compliant and to be able to get enough money into the plan from sources other than ours, because we're one of two funding mechanisms ultimately for the plan. There's contributions from the employer and the employee, and there's investment returns. That's how the plan's funded. So I see it as a qualification on our fiduciary duty. I think it's something that we have to consider when we're looking at how we manage the plan and how we set asset allocation. And if for some reason we feel that assumed rate of return will require us to take too much risk in order to achieve, or that we think that there is a significant, for instance, if we were adopting something and the probability of earning 7.25 was 25%, or, you know, and there's no hard number. I mean, it's completely subjective. I think it would be incumbent upon us to obviously inform our, you know, our sister agency at PIBA, who, you know, is in consultation with the actuaries, and also inform the General Assembly that we feel like that's just an unattainable rate of return. That doesn't mean that it's going to change, because ultimately the way that the statute works is it's set in statute now until 2021, and then we revisit it. So, and we've moved the ball thankfully we've moved the ball from the General Assembly just sets it in stone and statute to Now, PIBA, with consultation with us and the actuaries, makes a recommendation every 4 years as to what the assumed rate of return should be for the next 4 years. And it acts kind of like a regulation where the General Assembly either approves it, can affirmatively approve it or disapprove it or set its own, but if it takes no action, it just becomes the assumed rate of return. So I think it's and ultimately, I think it's kind of the collective, feeling of the commission as to, if we adopt, for instance, if we adopt policy Y, there's a 52%, there's a 52% probability of achieving an annualized rate of return of 7.25 or better over that time period. Does that comport with our fiduciary duty and comport with the expectation from the plan sponsor of the rate of return? So, and if not, then I think we need to, I think unlike maybe where we haven't necessarily done in the past, if we've adopted something that we don't expect to get that, we haven't necessarily rang the bell, so to speak. So, so if we don't think we can get there, if we think it requires too much risk or whatever, I think it's incumbent upon us to inform the plan sponsor and our other stakeholders that we don't think that we can get there. But if we think that this is a prudent path to kind of, to comply with our fiduciary duty and the expectation, then I think we can feel comfortable in moving forward that way. So hopefully as to take a line from Jeff, that's a very long-winded answer to your question, but hopefully it's informative as to at least that's how I perceive the duty.
No, and I appreciate those comments. I think that was a good answer.
Would you want me to?
Okay.
Would you want me to articulate the motion, and then if somebody would want to make that?
Sure.
Okay. Thank you, Madam Chair. The motion would be, and it's my understanding, Madam Chair, that it will not be necessarily the sentiment of the commission to take up, because in your printed materials and the open session motions, there's a part regarding benchmarks, but maybe that is a
topic for next meeting?
Yeah, a topic for next meeting. So, the commission, so the motion would be the commission adopts the recommendations of Makita and the CIO to approve the asset allocation as presented on red document number page 88. And that would be the asset allocation report from Makita.
48.
48. Yeah, red number page 48. I said 48. Well, I meant to say 48. It says 48. It says 48 up there. Don't pay any attention to what I said. Page 48 of the asset allocation, red number page 48 of the asset allocation report from Makita, dated February 8th, 2018, in the open session materials, and that would be asset allocation, recommended asset allocation Y. If anyone would like to make the motion.
Make the motion.
Do we have a second?
I'll second.
We have a second. Any further discussion on this? If not, all in favor, say aye.
Aye.
Any nays? Abstentions? Okay, ayes have it.
Okay, thank you, Madam Chair.
Oh, Reynolds?
I voted aye.
Very
Okay,
good.
there
Very
we
good.
go.
Thank you, Reynolds. All right. And
Okay, so I think the next order of business is that we need a motion to proceed into executive session to discuss investment matters pursuant to all of those numerous SC codes and sections, and to receive legal advice from legal counsel pursuant to more SC code sections and related to litigation filed by American Timberlands Fund 2 LP, and to receive advice from legal counsel pursuant to even more SC code sections.
Yeah.
Is that so moved?
I move.
Do we have a second?
I'll second that.
All in favor?
Aye. Very good.
Okay. No action was taken in executive session, and now we're looking for a motion to adjourn.
I'll make the motion.
Second.
All in favor?
Aye.
Aye. Thank you all very much.
Thank you very much.
Thank you.